Imagine walking into a casino. You go to the roulette table, put your entire life savings on black, and the ball lands on black. You double your money. You walk out a hero. Now let me ask you a serious question. Are you a genius or are you just lucky? In the last few years, millions of people confused luck with genius. They confused a bull market with skill. And because of that, they lost everything when the music stopped. This happens because a huge part of the financial industry, the brokers, the trading apps, even the financial news channels, they all profit when you're confused. They want you to think that trading stocks rapidly on your phone is investing. It's not. Back in 1949, a man named Benjamin Graham wrote a book called The Intelligent Investor specifically to stop you from being the sucker at the table. Chapter 1 is titled Investment versus Speculation. Now, that might be the most boring title for what is arguably the most exciting and powerful concept in all of finance. If you can truly master the logic in this one chapter, you stop being a gambler and you start building a dynasty. Today, we are doing a deep dive. We're retaking Graham's rules from 1949 and dragging them kicking and screaming into the modern age of AI, crypto, and those crazy zero-day to expiration options. We're going to figure out if your portfolio is actually safe or if you read just one bad trade away from zero. So let's get into the lost definition of investing. Graham wrote, "An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative." You've probably heard this quote before, it's famous. But most people gloss over it and miss the powerful nuance packed into those few words. So let's tear it apart piece by piece and see what it really means for us today. The first part is thorough analysis. When Graham says thorough analysis, he doesn't mean I saw a TikTok about it. He doesn't mean I read a tweet from a finfluencer. He doesn't even mean I read a single article on Bloomberg. Thorough analysis implies work. It implies mathematics. In the modern world, what does this look like? It means, have you actually opened the company's 1OK report? That's the annual report they file with the SEC. It's long, it's boring, and it's where all the secrets are buried. Do you know the company's debt-to-equity ratio, which tells you how much leverage and risk it's taking on? Do you understand its free cash flow yield? This is the real cash profit the business generates, relative to its stock price. It's the lifeblood of a company. If you buy a stock simply because the price chart is going up and to the right, you are not analyzing the business. You are analyzing the market's mood swings. You're analyzing crowd behavior. That is not analysis. That is momentum surfing. It can work for a while until it doesn't. A true investor analyzes the business like they are going to buy the entire company, not just a few digital shares on a screen. Next up, part 2. Safety of principle. This is the one that trips everyone up. It's controversial. Safety does not mean the price of your stock will never ever go down. That's a fantasy. If you buy a great company like Microsoft or Apple, the stock price will fluctuate. It will go up. It will go down. That's normal market noise. Safety of principle means something deeper. It means looking at the underlying business and asking 2 critical questions. First, is there a realistic, foreseeable chance that this company could go bankrupt? Not just have a bad quarter, but actually go to zero. And second, is there a realistic chance that I am overpaying so much for this stock that I will never earn my money back in a reasonable time frame? Let's look at a classic example. Back in the dot-com bubble of 2000, Cisco Systems was a fantastic company. It was building the backbone of the internet. It was a solid, innovative business. But investors got so euphoric that they bid the stock price up to an insane valuation. If you bought Cisco at its peak in March 2000, even though it was a great company that didn't go bankrupt, it took you 16 years just to break even on your investment. 16 years of your money doing nothing. That was not a safe investment at that price, even though the company itself was solid. The price you pay determines your safety. Buying a wonderful company at a terrible price is a speculative act. Finally, we have the third part of Graham's definition, a satisfactory return. Notice the word he chose. Satisfactory. He did not say mind-blowing. He did not say extraordinary. He did not say, get rich next Tuesday. The speculator is always chasing the 100% return in a week. They see a meme stock soaring and they get intense FOMO. They want to turn $1,000 into $100,000 overnight. The investor, on the other hand, is perfectly happy with compounding their money at 8%, 10%, or maybe 12% per year consistently over decades. Why? It sounds boring, right? But here's the magic. That boring 10% return, when compounded over a career, is what makes you a millionaire. It's the reliable, repeatable engine of wealth creation. Those spectacular 100% returns? They almost always come with a hidden risk. The 100% risk of total ruin. You might win once, you might even win twice. But if you keep playing that game, the math will eventually catch up to you. The house always wins. The speculator wants to hit the jackpot. The investor wants to own the casino. So let's bring it all together. What does this mean for you right now with your portfolio? Take an honest look at your holdings. For each one, ask yourself Graham's 3 questions. First, did I do a thorough analysis of the business itself? Do I understand how it makes money, what its debts are, and what its long-term prospects are? Or did I just buy it because a YouTuber got excited or because the price was going up? Second, is my principal safe? Not from daily price swings, but from permanent loss. Is there a real risk the company goes bust? Am I paying a price so high that it might take a decade or more just to get back to even? This is where the concept of margin of safety comes in, buying a company for significantly less than its intrinsic value. And third, am I seeking a satisfactory return? Am I looking for steady, long-term compounding, or am I swinging for the fences, hoping for a lottery ticket payout? Be honest, if you look at your positions and realize they don't meet these 3 simple criteria, then you're not investing, you're speculating. And there's nothing wrong with speculating, as long as you know that's what you're doing. You should only do it with a very small amount of money that you are fully prepared to lose. Your Vegas money. But you must never, ever confuse it with the serious business of investing your life savings. By internalizing this one simple definition, you change the game entirely. You stop reacting to every news headline. You stop checking your portfolio every 5 minutes. You stop chasing hot trends. Instead, you start acting like a business owner. You focus on quality, you focus on price, and you focus on the long term. You stop being the gambler at the table, and you start becoming the house. That is the true path to building lasting wealth. So, we've covered Graham's timeless rules for separating investing from speculating. But how do these old school principles apply to the wild world of modern markets? Let's put them to the test with some real-world examples. First up, let's talk about the pure hype assets. Think about something like Dogecoin or maybe one of those unprofitable SPACs that were all the rage. Let's run it through the Graham gauntlet. Rule 1. Thorough analysis. Can you actually analyze the fundamental business of Dogecoin? I mean, can you project its future cash flows? The answer is no. It doesn't generate cash. It doesn't produce anything. Sure, you can analyze the community, the memes, the hype cycle, but you can't analyze its intrinsic value in a traditional business sense. The price is driven entirely by sentiment and momentum. Rule 2. Safety of principle. Is your initial investment safe with something like this? Absolutely not. Its value is completely dependent on what's called the greater fool theory. This is the idea that you can buy something overpriced because you're banking on finding someone else, a greater fool, who is willing to pay an even higher price for it later on. You're not buying a piece of a business. You're buying a lottery ticket, hoping someone else will buy it from you for more. There is no underlying value to catch you if the price falls. And Rule 3. An adequate or satisfactory return. Let's be honest, if you're buying Dogecoin, you're not looking for a satisfactory 7% or 10% annual return. You're swinging for the fences. You're hoping for a 10x, a 100x, a miracle. You're looking for life-changing money, not a steady, predictable gain. So what's Graham's verdict? He would label this without a doubt as pure speculation. Now, does this mean you're forbidden from ever buying it? No, not necessarily. Graham was a pragmatist. He knew people loved to take a punt. But he would insist on one crucial thing. You must strictly separate and label it. You cannot, under any circumstances, call this your retirement fund. This is your speculation fund, your Vegas fund, or your fun money. The golden rule is that if this investment goes to zero tomorrow, it should have absolutely no material impact on your financial life or your long-term goals. It's a gamble and you have to treat it as such. Don't ever confuse it with true investing. Okay, that was the easy one. Now let's move into the gray area where things get a lot more interesting and a lot trickier. Let's talk about the massive, world-changing, incredibly successful companies of our time. I'm talking about giants like Nvidia or Tesla. These aren't just memes. They have real products, real factories, massive revenues, and real earnings. They dominate their industries. So buying stock must be investing, right? Well, this is where it gets complicated. This is the part of Graham's philosophy that trips a lot of people up. He acknowledged that virtually all common stocks, even of the best companies, have a speculative element. Why? Because when you buy a stock, you're not just buying its past performance. You are inherently making a bet on its future. The future is, by its very nature, uncertain. Let's take Nvidia as an example. It's an incredible company at the heart of the AI revolution. But let's say it's trading at a price-to-earnings, or PE ratio, of 80. What does that number mean? It means for every $1 of Nvidia's current annual profit, you are paying $80. To put that in perspective, a historical average PE for the broader market is closer to 15 or 20. When you pay such a high price, you are not just buying the company as it is today. You are making a huge speculative bet that its growth will continue to be absolutely explosive for many, many years into the future. You're betting that it will grow into that valuation. Is it possible? Of course. Nvidia is a phenomenal company. But is it guaranteed? Absolutely not. Anything from increased competition, to new regulations, to a slowdown in AI demand could derail those lofty growth expectations. That uncertainty, that reliance on a very specific, very optimistic future playing out is the speculative component. The higher the price you pay, the more speculation is baked in. So how do we apply Graham's intelligent approach here? It comes down to your process and your intent. This is the most important lesson. The difference between investing and speculating isn't always the asset itself. It's you. It's the mindset and the work you put in before you click buy. Let's imagine two people buying Nvidia stock today. The first person is our intelligent investor. They've done homework. They've studied the semiconductor industry. They've analyzed Nvidia's competitive advantages. And they've built a detailed financial model projecting its future cash flows for the next decade. Based on this rigorous analysis, they've calculated what they believe is a fair value for the stock. If the current market price is at or below their calculated fair value, they buy. They have a rational basis for believing the price they are paying is justified by the future prospects of the business. According to Graham, this person is investing. Now let's look at the second person. They see that AI is the hottest trend. They read headlines about Nvidia's stock price soaring. Their friends are all talking about how much money they're making. The chart is a beautiful, straight-line elevation map. They see all this green and get a massive case of FOMO, the fear of missing out. They buy the stock simply because it is going up and they hope it will continue to go up. They have no idea if the price is fair. They've done no analysis of the underlying business. They are just riding the wave of momentum. According to Graham, this person is speculating. Do you see the difference? It's the exact same stock bought at the exact same time. But one action is investing, and the other is pure speculation. The dividing line is the work you do and the reason you buy. Are you buying based on a rational calculation of value, or are you buying based on emotion and a hope that the price will go up? This is the core of what it means to be an intelligent investor. It's about replacing emotion with discipline and replacing hype with analysis. It's about knowing why you own what you own. So before you make your next investment, ask yourself, am I an investor? Why is speculation so addictive? The legendary investor Benjamin Graham talks a lot about the psychology of the market. Let's be honest, it feels good to gamble. It hits the dopamine centers of your brain, that little rush when you think you've picked a winner, and Wall Street absolutely loves speculators. Think about it this way. An investor buys an S&P 500 ETF and just holds it for 30 years. Over that entire time, their broker makes almost $0 in fees. Now compare that to a speculator who's buying and selling options 10 times a day. Every single trade, the broker gets paid, the market maker gets paid, and even the tax man gets his cut. It's no accident that modern trading apps are completely gamified. They're designed from the ground up to turn you into a speculator. They throw digital confetti at you when you make a trade. They constantly show you the top movers of the day to trigger your FOMO, that fear of missing out. You see a stock up 50% and think, I've got to get in on that. Graham gave us a crystal clear way to tell the difference. He said, the most realistic distinction between the investor and the speculator is found in their attitude towards stock market movements. What does that mean? The speculator wants the price to go up right now so they can sell it for a quick profit to the next person. The investor, on the other hand, actually wants the price of a good company to go down because it gives them a chance to buy more of a great thing at a discount. It's a total mindset shift. Okay, I know what you're thinking, but I want to have some fun. I want to buy that risky tech stock my buddy told me about. I get it. And the good news is Benjamin Graham allows for it. He's not telling you to live a boring life. In chapter 1 of his book, he makes a crucial distinction between intelligent speculation and unintelligent speculation. Let's start with what not to do. Unintelligent speculation has 3 major sins. The first, and by far the worst, is speculating when you think you're investing. This is when you put your retirement money into a highly volatile stock, convincing yourself it's a long-term hold when you're really just hoping for a quick pop. The second sin is speculating seriously instead of treating it as a pastime. If you're losing sleep, checking prices every 5 minutes, and letting it affect your mood and relationships, you're taking it too seriously. The third sin is the most obvious, risking more money than you can actually afford to lose. If a speculative bet going to zero would change your life for the worse, you shouldn't be making it. So how do we do it the intelligent way? Graham gives us a set of rules for how to play the game correctly. First, and this is non-negotiable, you must segregate your accounts. You need an investment account and a separate fun account. The investment account is for the boring, safe stuff, your ETFs, your blue chip stocks, the foundation of your wealth. The fun account is your casino money. This is where you put your crypto, your options, your moonshots. You must never ever mix the money between these 2 accounts. Second, you have to limit the size of that fun account. Graham suggests never putting more than 10% of your total equity into speculation. So if you have a total portfolio of $10,000, and the third rule is a psychological one, you have to admit to yourself that you are gambling. Just saying the words out loud, I am gambling on this stock, completely changes your perspective. It removes the ego and the emotion. It helps you mentally prepare for and accept the loss if it happens, because you went into it knowing it was a high-risk bet, not a sure thing. So how do we tie all this together? I want you to do something for me today. It's an exercise I call the sleep test audit. Here's what you do. Step 1, open your brokerage app. Step 2, look at every single ticker symbol you own, one by one. Now for step 3, you need to ask yourself 3 questions for each and every holding. First, if the stock market closed for the next 5 years, starting tomorrow, would I be happy and comfortable holding this investment? Second, do I actually know how this company makes money? Could I explain its business model to a 10-year-old? And third, be honest with yourself. Did I buy this because of math and sound analysis, or did I buy it because of FOMO and hype? If you can't answer those questions confidently, you are speculating. And if you're speculating with money that you need money for a down payment, for your kids' education or for your retirement, you need to sell it today and move that money into something that fits Graham's definition of a true investment. Being an intelligent investor isn't about being the smartest person in the room or having a genius IQ. It's about having more emotional discipline than everyone else. Chapter 2. The investor and inflation. Most people think inflation is just stuff getting more expensive. Benjamin Graham, the father of value investing, says no. Inflation is a hidden tax. It is a force that systematically destroys the wealth of the cautious person while rewarding the owner of real assets. Today, we're diving deep into Chapter 2 of his masterpiece, The Intelligent Investor, to understand this silent killer of wealth. We're going to explore why holding cash can be a catastrophic mistake, why gold might not be the foolproof answer everyone thinks it is, and most importantly, how to build a portfolio that not only survives but thrives when the cost of living goes through the roof. Let's start with the biggest illusion in personal finance, the idea that cash is safe. Imagine you put $100,000 under your mattress back in 1990. Fast forward to today, you pull it out and you still have exactly $100,000. You didn't lose a single penny, right? Wrong got so incredibly wrong. That $100,000 in 1990 could have bought you a nice house in many parts of the country. Today, it might get you a decent mid-range SUV. The number of dollars stayed the same, but what those dollars can buy, their purchasing power, has been decimated. This is the core of Graham's warning. He points out a painful irony: the so-called conservative investor, the person terrified of the stock market's ups and downs, is actually taking on the maximum risk by hoarding cash or parking their money in low-interest bonds. Why? Because they are completely exposed to the guaranteed slow-motion train wreck of inflation. If you look at a chart of the purchasing power of the US dollar over the last century, it only goes one way: down. It's a relentless, steep decline. Graham's rule here is brutally simple. If your money isn't growing at a rate that is faster than inflation, you are getting poorer every single day. You're not saving. You're just losing money slowly. You're running as fast as you can on a financial treadmill, sweating and working, just to stay in the exact same spot. The intelligent investor understands that the real risk isn't volatility. It's the permanent loss of purchasing power. This brings us to a critical psychological trap that Graham wants us to avoid, a concept economists call the money illusion. It's one of the most common and dangerous cognitive biases in finance. Imagine you open your high-yield savings account app and you see that you earned 5% interest this year. On your $10,000, that's a cool $500. You feel great. You feel like you're winning. Your balance is bigger, you've made money, but wait. What if, during that same year, the official inflation rate was 7%, like we saw not too long ago? Now let's do the real math. Your nominal return, the number on the screen, is plus 5%. But the inflation rate, the rate at which your money loses value, is minus 7%. So your real return, what actually matters, is negative 2%. In reality, you didn't make $500. You lost $200 in purchasing power. You can now buy less with your $10,500 than you could with your original $10,000 a year ago. You feel richer, but you are actually poorer. Graham was obsessed with this distinction. He relentlessly urged investors to stop focusing on nominal returns and start focusing exclusively on real returns. The intelligent investor doesn't get excited about having more dollars. They get excited about having more purchasing power. They understand that the goal isn't just to grow the number in their account. The goal is to grow their ability to buy the things they want and need in the future. Breaking free from this money illusion is the first step toward true financial intelligence. It's about asking the right question, not how many dollars do I have, but what can my dollars do for me? So if cash is a losing game and bonds often can't keep up, how do we fight back against this silent wealth destroyer? The common advice you'll hear all over the internet is simple. Buy gold. Gold is the ultimate inflation hedge, right? It's the ancient store of value, the safe haven in times of crisis. Well, Graham had a very interesting and somewhat contrarian take on this. He was actually quite skeptical of gold as a primary investment. His reasoning was cold and logical. What does gold do? Nothing. It just sits there. It doesn't produce anything. It pays no dividend. It has no earnings. It doesn't generate cash flow. When you buy gold, your entire investment thesis relies on one thing: hope. You're just hoping that in the future, someone else will be willing to pay more for it than you did. Graham viewed this as speculation, not investing. So, what did he recommend? What did he believe was the best long-term hedge against inflation? Stocks. Or, more precisely, owning pieces of excellent businesses. The logic is beautifully simple and powerful. Think about it. When inflation hits and the cost of everything goes up, what happens to a great company like Coca-Cola? They raise the price of a can of Coke. What does a company like Chipotle do? They raise the price of a burrito. This is called pricing power, and it's a company's first line of defense against inflation. Because these companies are charging more for their products, their revenues go up in nominal dollar terms. And as their revenues and profits rise with inflation, they can also increase the dividends they pay out to shareholders. So, as an owner of the business, a shareholder, you are protected. The rising costs that hurt you as a consumer are passed on, and they actually benefit you as an investor. Your slice of the pie, your dividend income, grows right along with the rising prices. History overwhelmingly supports Graham's view. Over any significant long-term period, 20, 30, even 50 years, a diversified portfolio of stocks has consistently beaten inflation by a wide margin. Cash has failed miserably. Long-term bonds have often failed. But good businesses, the ones that make the products and services we all need and want, have proven to be remarkably resilient. They pass the costs on to the consumer. That's you, and protect the shareholder. That's also you if you are an intelligent investor. So, let's put it all together. What is the practical takeaway from Chapter 2? Graham isn't telling you to put 100% of your money in the stock market and pray. He was, after all, a conservative investor. He advocated for a balanced approach. His famous recommendation was to maintain a portfolio that's roughly split between stocks and bonds, perhaps 50-50ths and rebalancing as market conditions change. But he also introduced a key innovation for his time: TIPS, or Treasury Inflation-Protected Securities. These are government bonds where the principal value actually increases with inflation. So they provide a direct, guaranteed hedge. A modern interpretation of Graham's wisdom might look like this. You have a base layer of defense. Part of your portfolio is in inflation-protected bonds like TIPS, which guarantees you won't lose purchasing power on that portion of your money. Then you have your engine for growth. The other, larger part of your portfolio is invested in a diversified basket of high-quality, dividend-paying stocks. These are the businesses with strong brands and pricing power that can thrive during inflationary periods. This two-pronged strategy gives you the best of both worlds. You have the safety net of TIPS protecting your principal from being eroded, and you have the powerful growth engine of stocks to increase your real wealth over time. This isn't about timing the market or picking hot stocks. It's about building a robust, all-weather structure for your finances. It's about acknowledging the reality that inflation is a permanent feature of our economy and positioning yourself not just to survive it, but to profit from it. Now, Graham didn't have access to every financial tool we have today. If you were writing Chapter 2 now in 2024, he would almost certainly talk about two other massive inflation shields that we have at our fingertips. First, REITs, or real estate investment trusts. Think about it. When inflation goes up, what happens to your rent? It usually goes up too. Real estate, whether you own it directly or through a REIT, is a natural hedge against inflation because its income stream, the rent, tends to rise with the cost of living. This makes it a powerful tool for preserving your wealth. Second, TIPS, or Treasury Inflation-Protected Securities. The name says it all. These are special government bonds specifically designed to protect you from inflation. Their principal value actually increases when inflation goes up, which means the interest payments you receive also increase. They are built from the ground up to fight the very problem we're talking about. So here's a crucial mindset shift for you. If you are absolutely terrified of a stock market crash, your first instinct might be to pull everything out and go to cash, but that's a guaranteed loss. The intelligent investor doesn't go to cash. They go to TIPS or real estate. That is how you stay safe without guaranteeing that your purchasing power will slowly bleed away. You're shielding yourself from one risk, a market crash, without completely exposing yourself to another inflation. Alright, enough theory, we need an action plan. Something you can do right after watching this video. I call it the grocery cart audit. It's a simple two-step reality check. Step 1, I want you to look at your real-world expenses. Grab your bank statements or just think back. How much more are you paying for your weekly groceries and for a tank of gas now compared to 3 years ago? Is it 20% more? 30%? Maybe even more? Get a real number that reflects your personal inflation rate. Now, step 2, look at what you consider your safe money. This is the cash in your savings accounts, your certificates of deposit, your regular bonds. Over that same 3-year period, did that money grow by 20 or 30%? Did it keep pace with your grocery bill? If the answer is no, and for most people it will be, then you are leaking wealth. It's not a dramatic overnight loss like a market crash. It's a slow, quiet bleed. Every day, your money buys a little bit less. Your financial foundation is silently eroding. So the key action step from this chapter, the takeaway I want you to remember, is to ensure that a significant portion of your portfolio is invested in productive assets. These are assets that have the power to raise their prices and their income to combat inflation. We're talking about stocks of strong companies that can increase the price of their products, and real estate, which can increase rents. You cannot hide in cash forever. It feels safe, but it's a trap. I know inflation is a boring topic. It doesn't have the drama of a stock market crash. It's slow, It's silent. But it is absolutely deadly to your long-term financial health. The intelligent investor respects the risk of a market crash, but they have just as much respect for the certain corrosive risk of the eroding dollar. Don't let the silent killer win. Chapter 3. A Century of Stock Market History. If you had invested $10,000 in the S&P 500 in the year 2000, by 2002 you would have had $6,000 left. You lost 40% of your money. But if you did the same thing in 2009, by 2011 you would have nearly doubled your money. This is the chapter where Benjamin Graham destroys your crystal ball. He proves with cold hard data that Wall Street's favorite pastime forecasting the future is a scam. Today, we are going to learn why experts are usually wrong, how to spot a bubble before it pops, and how to invest when you have absolutely no idea what will happen tomorrow. Let's dive into the biggest trap in investing. This time is different trap. In every bull market, people start to believe the rules have changed. In 1929, they said it was a new era. In 1999, they said, the internet changes everything. In 2021, they said, crypto changes everything. Sound familiar? Graham calls this dangerous thinking. He noticed a simple but devastating pattern. Step 1, the market goes up for a few years. Step 2, investors assume it will keep going up forever. Step 3, they start buying stocks at any price, completely ignoring what the company is actually worth. And step 4, gravity returns and everything comes crashing down. Graham's warning in Chapter 3 is simple. Do not project the immediate past into the future. Just because stocks went up 20% last year does not mean they will go up 20% this year. In fact, historically, periods of high returns are usually followed by periods of low returns or even losses. This is a concept called reversion to the mean. What goes up, especially too fast, must eventually come back to its average. Think of it like a pendulum. It swings high on one side, but it can't stay there. It always swings back through the middle and often to the other extreme. When everyone is euphoric and thinks they've found the secret to permanent wealth, that's precisely when you should be most careful. Graham's point isn't to be a pessimist. It's to be a realist. The market has a long and brutal history of humbling those who think they can outsmart it. So, if we can't predict the future, are we just flying blind? Not at all. Graham gives us a tool. Think of it as a thermometer. We can't tell what the weather will be next week, but we can definitely tell if it's hot or cold right now. That thermometer for the stock market is valuation. Graham looks at the price-to-earnings ratio, or PE ratio, of the entire market. This simple number tells you how much investors are willing to pay for every dollar of a company's earnings. When the PE is high, say over 25, it means the market is extremely optimistic. People are paying a huge premium. Graham would call this a high-risk environment. It's like buying a summer coat in the middle of a heat wave. You're paying top dollar. Conversely, when the PE ratio is low, let's say under 15, the market is pessimistic. Fear is everywhere. But this is where the intelligent investor sees opportunity. Stocks are on sale. This is a high opportunity environment. It's like finding a high-quality winter jacket for 70% off in July. You might not need it right now, but it's a great deal. In modern times, we often use a more advanced version of this called the Shiller PE ratio, or CAPE ratio, which smooths out earnings over 10 years. And when you look at a chart of the CAPE ratio over the last century, a clear pattern emerges. Every time it hits a major peak like in 1929-2000, and 2021 a market downturn tends to follow. The intelligent investor's strategy isn't about predicting the exact day of the crash. It's about recognizing the temperature. You buy when the thermometer is low and you become much more cautious, perhaps selling some of your overpriced holdings, when the thermometer is bursting. This brings us to the core of Graham's philosophy for the average person, the two-bucket strategy. Instead of trying to time the market, which we've established as a fool's errand, you divide your money. Graham suggested a simple split, one bucket for stocks and one for bonds. Your default position might be a 50-50th split. Now, here's where the valuation thermometer comes into play. When the market gets hot and expensive, when that PE ratio is soaring, you don't panic sell everything. You simply and calmly rebalance. You sell some of your now overpriced stocks and move that money into the safety of your bond bucket. You might shift your allocation to 25% stocks and 75% bonds. You're taking profits off the table and reducing your risk when everyone else is getting greedy. Then, the opposite happens. The market crashes. Everyone is panicking, headlines are screaming, sell, sell, and the PE ratio is in the bargain bin. What do? You do the opposite of the crowd. You calmly rebalance back. You sell some of your safe bonds and use that cash to buy stocks at a massive discount. You might shift your allocation to 75% stocks and 25% bonds. This is the ultimate buy low, sell high strategy, but it's systematized. It removes emotion from the equation. You're not guessing. You're reacting to the market's temperature. This discipline is what separates the intelligent investor from the speculator. It forces you to be greedy when others are fearful and fearful when others are greedy. Let's make this real. Imagine it's late 1999. The dot-com bubble is in full swing. Petscom is a household name, and your neighbor is quitting his job to day trade tech stocks. The Shiller PE ratio is at an all-time high, over 44. The thermometer is screaming hot. The intelligent investor, following Graham's advice, would have been trimming their stock positions all the way up, rebalancing into bonds. They might have felt a little foolish for a while as the market kept climbing. But when the bubble burst in 2000 and the Nasdaq fell nearly 80%, who was sleeping soundly? The investor who had locked in profits and was sitting on a pile of safe bonds. Then, fast forward to March 2009, the financial crisis has wiped out the market. The world feels like it's ending. The Shiller PE ratio has plummeted to around 15. The thermometer is ice cold. Everyone is terrified of stocks. But the intelligent investor sees the sale of a lifetime. This is the moment they've been waiting for. They rebalance aggressively, selling their safe bonds and pouring that money into the stock market, buying shares of excellent companies at prices not seen in years. The people who did this saw incredible returns over the next decade. They didn't predict the bottom. They didn't need to. They just followed the thermometer and the discipline of rebalancing. So, what's the key takeaway from Chapter 3? Stop trying to be a fortune teller. Wall Street pays people millions to predict the future, and they are consistently wrong. Instead, become a historian and a realist. Understand that markets move in cycles of greed and fear. Your job isn't to predict these cycles, but to recognize them and react rationally. Use valuation, like the PE ratio, as your thermometer to gauge the market's mood. Is it euphoric and expensive, or is it terrified and cheap? And finally, implement a disciplined strategy, like Graham's 50/50th stock bond split with rebalancing. This automates the process of buying low and selling high and protects you from your worst enemy, your own emotions. Investing isn't about having a crystal ball. It's about having a rock-solid, time-tested process. Turn on the TV and what do you hear? The market is going to the moon. The S&P will hit 6,000 by year-end. Then you change the channel. A massive recession is coming next month. Sell everything. It's enough to give you whiplash. You know who hated all of this noise? Benjamin Graham. He laid it out crystal clear in his book. He said, "We have not known a single person who has consistently made money by following market forecasts." Let that sink in for a moment. This isn't some random guy on the internet. This is the father of value investing, Warren Buffett's mentor, telling us that all those experts shouting on TV, they don't know what's going to happen. Nobody knows anything for sure. Think about what this means for you. If you build your entire financial life on a prediction, you're not investing. If you say, "I'm sure the market is going to crash, so I'm holding all my money in cash," you are speculating. You're essentially gambling on a guess. And if you're wrong, you miss out on potentially life-changing gains. On the flip side, if you go all in because someone promised you the market would double, you're setting yourself up for potential disaster. The intelligent investor operates from a place of humility. They admit they don't have a crystal ball. They don't know the future. And because of this, they build a portfolio that is designed to survive any future. A crash? They're prepared. A surprise rally? They're positioned to benefit. This is about building a robust, resilient financial fortress, not a flimsy tent based on a weather forecast that's probably wrong anyway. So how do we actually do this? If we can't predict the future, how on earth are we supposed to invest our hard-earned money? This is where Graham gives us a brilliant, actionable framework. I call it the history-proof protocol. It's a system that doesn't rely on guessing games. It relies on principles that have been proven to work over decades of market ups and downs. So I want you to grab your phone or log into your brokerage account right now. We're going to do a quick checkup on your portfolio. This is a practical, hands-on exercise. There are 3 simple things I want you to look for. First, the allocation check. This is the bedrock of your portfolio stability. Graham suggested a simple baseline, a 50-50th split. That's 50% in stocks and 50% in bonds, or even a high-yield savings account. This is your neutral gear. Now, here's the intelligent part. You don't change this allocation based on a news headline or a gut feeling. You change it based on value. How does that work? You look at the overall market's valuation, often using something like the price-to-earnings or PE ratio. When the market gets super expensive, when everyone is euphoric and prices are sky-high, you might lean more defensively. Maybe you shift your portfolio to 25% stocks and 75% bonds. You're reducing your risk when the odds are less in your favor. Conversely, what happens when the market crashes? When there's blood in the streets and everyone is panicking? That's when valuations become cheap. That's your signal to lean in. You might shift to 75% stocks and 25% bonds. Notice the key difference here. You are adjusting based on price and value, not on some wild prediction about where the market is going next week. You're being a business person, buying more when things are on sale and less when they're overpriced. The second part of the protocol is the DCA rule. DCA stands for dollar cost averaging. This is one of the most powerful, and yet simple, concepts in all of investing. It means you invest the same dollar amount on a regular schedule, say, every month, regardless of what the market is doing. Whether the headlines are screaming bull market or bear market, you invest. This simple act of consistency automates Graham's core logic. Think about it. When prices are low because the market has fallen, your fixed dollar amount automatically buys more shares. When prices are high, that same dollar amount buys fewer shares. Without any emotion or guesswork, you naturally end up buying more when things are cheap and less when they're expensive. It's a built-in discipline that forces you to act like an intelligent investor, even when your emotions are telling you to do the exact opposite. And finally, the third check, the 20-year horizon. I want you to stop looking at the 1-year chart of the stock market. Seriously, it's financial junk food. It's full of jagged, scary drops and volatile swings that are designed to make you panic. It tells you nothing about the true nature of long-term investing. Instead, pull up a 20-year chart of the S&P 500, or even longer if you can. What do you see? Yes, the line is still jagged. You'll see the dot-com bust, the 2008 financial crisis, the COVID crash. These are all scary vertical drops. But zoom out and look at the overall journey. What is the undeniable destination? It's up. The overall trend over any meaningful period of time is upward and to the right. History tells us, with 100% certainty, that the market will crash again. It's not a matter of if, but when. But that same history also tells us that it will recover. Every single time it has recovered and gone on to new highs. The only people who truly get hurt in this process, the ones who lock in permanent losses, are the ones who panic and sell at the bottom, or the ones who get greedy and go all in with money they can't afford to lose at the very top. By following this history-proof protocol, maintaining a flexible allocation, automating your buys with DCA, and keeping a long-term perspective, you remove the 2 biggest enemies of your financial success, fear and greed. You build a system that allows you to not just survive the inevitable storms, but to actually profit from them. You can sleep well at night knowing your financial future isn't built on a guess, but on a time-tested, proven strategy. Chapter 4. General Portfolio Policy. The defensive investor Wall Street wants you to believe that investing is a full-time job. They want you to think you need 6 monitors to read the financial news at 5 in the morning, and to have a minor heart attack every time a central banker clears their throat. Benjamin Graham, the father of value investing, says, nonsense. Welcome to our breakdown of Chapter 4 of The Intelligent Investor. This chapter is a gift to what Graham calls the defensive investor. Now, don't let that word fool you. Defensive doesn't mean scared. It doesn't mean weak. In Graham's world, defensive means passive. It's for the person who wants to protect their hard-earned money and get a decent, satisfactory return, but who absolutely refuses to spend their life staring at charts and worrying about every little market twitch. Today, we're going to build what I call the autopilot portfolio. It's a strategy designed to automatically force you to buy low and sell high, without you ever having to predict, guess, or even think about what the market will do next. This is the Lazy Millionaire's portfolio, and it's brilliant. Let's start with the cornerstone of this entire strategy. Graham gives us a golden rule for how to structure our investments. Our asset allocation dot, and it is elegantly simple dot, it's the 50/50th split. Imagine your entire investment portfolio is one big pie. You're going to slice it right down the middle into two equal halves. That's it, 50-50. Your portfolio is divided into two buckets. Let's call them Bucket A and Bucket B. Bucket A gets 50% of your money. This is your high-grade bonds bucket, or cash and cash equivalents. Think of this as your shield. This is what protects you from severe market crashes, from economic downturns, and from deflation. It's your fortress of stability. When everything else seems to be falling apart, this bucket holds firm. Bucket B gets the other 50%. This is where your common stocks go. Graham suggests focusing on a diversified group of leading companies, what we might call blue chip stocks today, or even simpler, a low-cost stock market index fund. This bucket is your sword. This is the part of your portfolio that fights inflation, that harnesses the long-term growth of the economy, and that actually builds your wealth over time. So, why this specific 50/50th split? Why not 70/30ths or 80/20ths? Because the 50/50th split is an act of humility. It is a direct admission of the most important truth we learned back in Chapter 3. You cannot, and you will not, consistently and accurately predict the future. No one can. By holding 50% in bonds, you are preparing for the worst. If the stock market crashes, if we enter a recession, your bond holdings will cushion the blow and provide stability. You'll be safe. By holding 50% in stocks, you are preparing for the best. If the market goes on a long, powerful bull run, your stocks will capture that growth and make you wealthier. You'll participate in the prosperity. With this simple split, you are structurally prepared for either outcome. You've removed the need to be a prophet. You've accepted that you don't know what's coming, and you've built a portfolio that is robust enough to handle it, whatever it is. Now, we get to the real magic. This next part is the secret sauce. This is the mechanical process that turns this simple portfolio into an intelligent machine that systematically beats the market's psychological traps. It's a concept called rebalancing. Rebalancing is what takes the emotion, the fear, and the greed completely out of the equation. Let's walk through an example. Imagine you start with your perfect 50/50ths portfolio. You have $100,000 invested, $50,000 in a stock index fund and $50,000 in a bond fund. Now let's say the stock market has an incredible year like it did in 2021. It goes on a massive run. Your $50,000 in stocks grows to, let's say, $70,000. Meanwhile, your bonds stayed pretty stable at $50,000. Now your total portfolio is worth $120,000. But look at the allocation. You now have $70,000 in stocks and $50,000 in bonds. That's no longer 50/50ths. It's closer to 58% stocks and 42% bonds. What does the average emotional investor do here? They see stocks are hot and they think, let it ride. Maybe I should buy even more. They get greedy, they chase the performance, but what does Benjamin Graham say? He says, stop. You must follow your rule. Your portfolio is now overexposed to risk. You've strayed from your plan. Your sword is too big and your shield is too small. The defensive investor's job is now simple and automatic. You sell just enough of your stocks to bring the allocation back to the 50/50ths target. In this case, your portfolio is 120K. Half of that is 60K, so you would sell $10,000 worth of your stocks, locking in those profits, and you move that $10,000 over into your bond bucket. Now you have $60,000 in stocks and $60,000 in bonds. You're back to 50/50ths. Let's flip the scenario. The market has a terrible year. It crashes. Your stock holdings drop from $50,000 down to, say, $30,000. Your bonds, being the stable shield, are still worth $50,000. Your total portfolio is now $80,000. What's the allocation? $30,000 in stocks and $50,000 in bonds. That's about 37% stocks and 63% bonds. The average person is panicking. Sell everything. The sky is falling. Fear takes over. But the defensive investor does the opposite. Their rule tells them exactly what to do. They are now underexposed to stocks. Their portfolio is too conservative. To rebalance back to 50/50ths on an $80,000 portfolio, they need $40,000 in each bucket. So they sell $10,000 of their safe bonds and use that money to buy $10,000 worth of stocks, which are now on sale at a huge discount. Do you see what just happened in these two scenarios? In the first one, when stocks were expensive and everyone was greedy, the rebalancing process forced you to sell. You sold high. In the second scenario, when stocks were cheap and everyone was fearful, the process forced you to buy. You bought low. You did this without any market forecasts. You didn't read a single analyst report. You didn't have an opinion on interest rates. You just followed the simple, unemotional math of your rebalancing rule. This is the genius of Graham's approach. It automates intelligent behavior. Now, Graham does offer a little flexibility. He says you don't have to be dogmatic about a perfect 50/50th split at all times. He suggests that the defensive investor can allow their allocation to drift within a certain range. For example, you could let your stocks fall to as low as 25% or rise to as high as 75% of your total portfolio. If you feel you have some insight into market valuations, for instance, if you believe stocks are outrageously expensive, you might choose to deliberately shift your allocation towards the more conservative end, maybe holding 75% in bonds and only 25% in stocks. Conversely, if you believe the market has crashed and stocks are incredibly cheap, you could shift to 75% stocks and 25% bonds. However, Graham offers a stern warning here. This is a slippery slope. For most people, especially those who want a truly passive, low-effort strategy, the simple 50/50th split with periodic rebalancing, say, once or twice a year, is the safest and most effective path. The main point is to have a rule and stick to it, preventing your emotions from making costly decisions. This strategy is not about getting rich overnight. It's about building wealth steadily, safely, and sanely over a lifetime. It's about sleeping well at night, knowing that your portfolio is prepared for whatever comes its way. You don't have to be a Wall Street genius. You just have to be disciplined. So the next time you see someone frantically watching the market, remember the wisdom of the defensive investor. Just stick to your 50/50ths plan. Rebalance periodically and let the system do the hard work for you. You'll likely end up ahead of most of them, and with a lot less stress. Now, Graham does allow some flexibility here. He calls it the slider. Think of it like a volume knob for your risk. He says you can slide that 50/50ths rule depending on how dangerous the market feels. During times of maximum fear, when you feel the market is dangerously high, like the bubble just before the 1929 crash or the dot-com bust in 1999, you can slide your allocation down to just 25% in stocks and a whopping 75% in bonds. This is your storm shelter. You're battening down the hatches, protecting your capital from a potential crash. On the flip side, during times of maximum greed, when everyone else is panicking and the market is basically on a fire sale, like in the depths of 2009, you can slide the other way. You can go up to 75% in stocks and just 25% in bonds. This is when you're being brave, buying quality companies when they are incredibly cheap. However, Graham gives us a huge warning here. Most people are absolutely terrible at judging this. Our human emotions get in the way. We tend to do the exact opposite of what we should. We get caught up in the hype and buy 100% stocks at the very top, and then we panic and sell everything at the absolute bottom, locking in our losses. So, unless you have nerves of steel and the emotional discipline of a Vulcan, Graham's advice is simple. Just stick to the 50/50ths rule. It is a beautifully simple system designed to protect you from your worst enemy in investing, yourself. It forces you to buy low and sell high without even thinking about it. Now let's talk about modernizing this for today. A big question is, what do we do with that bond bucket? Back in Graham's day, bonds were a great deal. They paid a reliable 5% or 6% interest. It was a no-brainer. But today, the bond market is, well, it's a bit weird, isn't it? Interest rates have been all over the place. So how do we apply this principle now in the 21st century? The key is to remember the function of this bucket, not necessarily the specific investment. The goal of this half of your portfolio is safety and stability. For the safe bucket, the modern defensive investor has a few great options. First, you have high-yield savings accounts. These are completely safe, FDIC insured up to the limit, and right now they're actually paying pretty decent interest. It's basically digital cash that earns you money. No risk, easy access. Second, you could use short-term treasuries, often through ETFs like SHV or SGOV. These are funds that hold very short-term government debt. They're considered one of the safest investments on the planet, basically cash that pays you a bit of interest. The price barely moves, so it's incredibly stable. Third, you could use a total bond market ETF, something like BND. This gives you a slice of the entire US bond market, government bonds, corporate bonds all mixed together. It's more diversified than just one type of bond. Ultimately, the specific vehicle you choose doesn't matter as much as its function. This money must be stable. It is the anchor that stops your financial ship from drifting away and crashing onto the rocks during a market storm. All right, now it's time to put this into practice. Let's do a quick autopilot audit. This is your action plan. Step 1. Log into your brokerage account right now. Go on, I'll wait. Take a look at your current allocation. What's the split? Are you 90% in stocks and 10% in cash? Maybe even more? You might be taking on a lot more risk than you realize. You're essentially driving a race car without a seatbelt. Step 2. Decide on your ratio. Are you going to be a pure, classic Graham 50/50th investor? Or maybe you're younger, you have a longer time horizon, and you feel comfortable being a bit more aggressive. Perhaps a 70% stock, 30% safe bucket split is right for you. Step 3. And this is the magic key that makes it all work. Set a calendar reminder on your phone or computer. Label it Rebalance Portfolio. Set it to repeat once every 6 months, or at the very least, once a year. On that day, you log in, look at your ratio, and adjust it back to your target. If stocks had a great run and are now 60% of your portfolio, you sell some and buy more of your safe assets to get back to 50/50ths. If stocks crashed, you sell some of your safe assets to buy more stocks on sale. And that's it. Seriously, that is it. You look at your portfolio maybe twice a year. The rest of the time, you sleep. You work, you go on vacation, you spend time with your family. You enjoy your life. That is the incredible luxury of being a defensive investor. You're not glued to the screen, you're not stressing about every headline. You have a system and you let the system do the work for you. So you've watched Chapter 4, you've got your defensive portfolio all set up. You have your 50% in bonds, which is your shield, and your 50% in stocks, which is your sword. But now you have a new problem. There are over 4,000 public companies in the US alone. Which ones do you actually put in that stock bucket? Do you buy the hot new AI startup everyone's talking about? Do you buy the company your uncle recommended at Thanksgiving? Or do you just throw a bunch of darts at a board and hope for the best? Benjamin Graham says, stop guessing. Graham hands the defensive investor a very strict checklist. He basically says if a company doesn't pass these 4 tests, you are not allowed to touch it. No exceptions. Today, we are going to learn how to build a portfolio that is bulletproof, boring, and, most importantly, profitable. Graham knows that the defensive investor doesn't want to spend 40 hours a week buried in balance sheets. You have a life to live. So he created a simple but powerful filter to weed out all the trash immediately. These are the 4 rules of entry, the 4 non-negotiables for buying a stock. Rule number 1 is adequate diversification. Graham says, don't be a hero. Never ever put all of your money into just 1 or 2 stocks. It's a recipe for disaster. He suggests holding somewhere between 10 and 30 different companies. Why? Because even a fantastic company can run into unexpected trouble. A scandal, a major lawsuit, a terrible CEO. Anything can happen. Think about it. If you own 30 companies and one of them goes completely to zero, you only lose 3.3% of your total stock portfolio. It'll sting, but you'll live. If you only own one company and it goes to zero, well, you might be moving back in with your parents. Diversification isn't just a suggestion, it's your seatbelt. Rule number 2 is what I call the big and prominent rule. The defensive investor should not be hunting for hidden gems in the penny stock bin. That's a speculator's game, and it's a dangerous one. Graham wants you to buy large-cap companies. He wants industry leaders, the kind of companies that literally everyone has heard of. Why? Because when a recession hits, and it will, the small speculative companies are the first to go bankrupt. But the giants? They usually survive. They have the brand power, the customer loyalty, and the financial muscle to weather the storm. We're talking about names like Coca-Cola, Johnson & Johnson, or Walmart. These are the battleships of the market, not the flimsy canoes. Rule number 3 is conservative financing. This is the safety check, and frankly, it's the rule that knocks out most modern tech stocks right away. Graham demands financial strength. For industrial companies, he wants their current assets to be at least twice their current liabilities. What does that mean in plain English? It means for every $1 of debt they owe in the short term, they should have at least $2 of cash or stuff they can easily sell for cash sitting in the bank. This is the classic current ratio. It's a quick test to see if a company is financially sound or if it's drowning in debt. If a business is highly leveraged and one bad quarter away from a crisis, the intelligent investor simply walks away. It's not worth the risk. And finally, rule number 4 is the dividend record. This is my absolute favorite rule. Graham insists on a long, uninterrupted record of continuous dividend payments. Specifically, he asks for at least 20 years of non-stop payments. Why is this so important? Because earnings can be faked. Accountants are clever, and they can legally manipulate profit numbers to make a company look healthier than it really is. But dividends are real cash. You cannot fake a wire transfer from the company's bank account to the shareholders. It's proof. If a company has successfully paid you cash every single quarter for 20 straight years, through recessions and market crashes, you know you're dealing with a real, durable business, not just a passing hype train. It's the ultimate sign of a company's stability and its commitment to its shareholders. So let's recap these 4 simple yet powerful rules for the defensive investor. First, you need adequate diversification between 10 and 30 stocks. Second, stick to large, prominent, financially sound companies. Third, ensure conservative financing, with assets far outweighing short-term debts. And fourth, demand a long and uninterrupted record of dividend payments. If you apply these 4 filters, you will automatically eliminate 99% of the stocks out there. You'll screen out the speculative junk, the overhyped story stocks, and the financially fragile businesses. What you're left with is a small, elite group of high-quality, stable companies. This isn't about finding the next 10-bagger overnight. This is about building a portfolio that lets you sleep soundly at night, knowing your capital is protected while it steadily grows over time. It's the very definition of intelligent investing. I can already hear the comments, but what about Amazon? What about Tesla? They didn't pay dividends for years. They were just small companies once. And you're right. Those are great questions. Benjamin Graham actually has a name for stocks like these. He calls them growth stocks. And for the defensive investor, the investor we're talking about today, he absolutely hates them. So why the hate? It's simple. Growth stocks are priced based on anticipation. You're not paying for the profits they're making right now. You're paying for the profits you hope they'll make in the future. It's all about speculation on future growth. And the problem is, if that growth slows down even a little bit, or if the market sentiment changes, the stock price can crash. We're talking 50, 60, even 70% drops. It's incredibly volatile. The defensive investor, following Graham's philosophy, prioritizes the safety of their principal above everything else. They want to protect what they have, not gamble for a home run. Leave the moonshots and the high-risk plays to the speculators and the gamblers. Our goal here is steady, reliable wealth building, not a trip to the casino. Now think about what it took to follow this strategy back in 1949 when The Intelligent Investor was first published. You had to manually find these 30 companies. You'd be digging through newspapers, reading dense annual reports, and doing all the math yourself with a pencil and paper. It was a ton of work. But today, in the 21st century, we have a cheat code, a shortcut that I'm convinced Graham would have absolutely loved. It's called the Low-Cost Index Fund, or more commonly, the ETF. Let's break down why this is the perfect modern tool for a Graham-style investor. When you buy a broad market index fund like one that tracks the S&P 500, think of EOE or SPY. Let's see what you're actually getting. First, diversification. Does it pass the test? Absolutely. You're not just buying 30 companies. You're instantly invested in the 500 largest companies in America. So, diversification? Check. And are these companies large and prominent? Well, the S&P 500 is literally a list of the 500 biggest, most established public companies in the US. So, big and prominent? Double check. Third, what about financial strength? This is a big one. To even get included in the S&P 500 index, a company generally has to be profitable. The index has rules to weed out the weaker players. So while it's not a perfect guarantee for every single company, on the whole, you're buying a basket of financially sound businesses. So financial strength? Mostly check. But maybe you want to be even stricter. Maybe you really want to stick to Graham's rule about a long history of uninterrupted dividend payments. Well, there's an ETF for that too. You can buy something called a Dividend Aristocrats ETF. The companies in this fund have not just paid a dividend, but have increased their dividend payment for at least 25 consecutive years. Think about that. Through recessions, through market crashes, through global crises, these companies have consistently not only survived but thrived enough to give more money back to their shareholders year after year. This is the ultimate autopilot version of Graham's strategy. It does all the hard work of finding and vetting these companies for you. It's a simple, effective way to apply these time-tested principles without spending all your weekends buried in financial statements. So, with all this in mind, here's your homework for this chapter. I want you to conduct what I call a junk removal audit on your own portfolio. It's a simple 3-step process. Step 1. Open up your brokerage account and look at the individual stocks you've picked yourself. Not the funds, just the single companies. Step 2. For each of those stocks, apply the 20-year test. Has this company paid a consistent dividend for the last 20 years? A quick search online for the company's name plus dividend history will tell you what you need to know. Step 3. Apply the sleep test. Ask yourself, if the market crashes tomorrow and the economy goes into a deep recession, does this company have the financial strength, the brand, and the cash on hand to survive? Can you sleep soundly at night owning this stock through a crisis? Be honest with yourself during this audit. If you find you're holding a company that has no earnings, is not paying a dividend, and is loaded up with debt, then you are violating the core rules of the defensive investor. You're not investing, you are speculating. And as we learned in the very first chapter, speculating is perfectly fine, but only with your casino money. That small portion of your portfolio you willing to lose completely. You should never ever confuse your speculative plays with your life savings. Your core portfolio, the money you're counting on for retirement and financial security, should be built on a foundation of safety and quality, just as Graham taught. So take some time this week to do your junk removal audit. Clean up the portfolio, align it with your true goals as a defensive investor, and set yourself up for long-term success. In our last video, we talked about Chapter 5 of The Intelligent Investor and built the lazy portfolio. It was safe, it was simple, it was kind of boring, but you know what? It works. It's designed to get you the market average reliably for the rest of your life. But I know some of you, I can hear you through the screen. You're not satisfied with average. You want to beat the market. You want to be an enterprising investor, and that's great. But before you jump in, Benjamin Graham has a crucial warning for you. If you want to play this game on hard mode, the first thing you have to learn is how to not die. That brings us to Chapter 6, which Graham calls Portfolio Policy for the Enterprising Investor, the Negative Approach. It's a brilliant idea. Before he even tells you what you should buy, he gives you a strict no-go list. These are the assets that Wall Street absolutely loves to sell you, but that the intelligent investor should refuse to touch. These are the financial landmines that can blow up your entire strategy. So let's get into the things you need to ban from your portfolio, starting with the most tempting one. Imagine a stranger walks up to you and asks to borrow $1,000. You have two options. Stranger A has a steady job, owns a house, and has a perfect credit score. He offers to pay you 5% interest. Then there's Stranger B. He's currently unemployed, has a bit of a gambling problem, and owes money to some shady characters. But he makes you a tempting offer. 15% interest. Who do you lend your money to? It seems obvious, right? You go with the safe bet. But here's the crazy part. Wall Street tries to sell you Stranger B every single day. They just give him a fancy name, a high-yield bond, or more accurately, a junk bond. Graham's advice on these is simple and direct. Stay away. Now you might be thinking, but I'm an enterprising investor. That 15% return sounds amazing, and that's exactly the trap. Graham warns that this high yield isn't a sign of opportunity. It's a giant red flag signaling immense risk. When the economy is great, everything might seem fine. But the moment a recession hits, Stranger B is the first one to lose his job and default on his loan. When that happens, the price of these junk bonds crashes. You don't just lose out on that juicy 15% interest you were promised, you risk losing your entire principal. Your $1,000 could vanish. Graham's rule is crystal clear. Do not get stuck in the muddy middle. If you want safety in your portfolio, you buy high-grade, top-quality bonds, like government treasuries or AA-rated corporate bonds. If you want profit and growth, you buy stocks. Junk bonds try to offer a little of both, but they end up giving you the worst of both worlds, the high risk of stocks without any of the long-term growth upside. It's a sucker's bet, designed to lure in the greedy and the uninformed. The intelligent investor knows better and walks away. Next on Graham's no-go list are foreign bonds. Now, hold on, I know what you're thinking. We live in a globalized world. Isn't diversification a good thing? Yes, but Graham's concern wasn't about geography. It was about information and stability. Back in his day, getting reliable financial data from other countries was incredibly difficult. Plus, there was a huge risk of currency fluctuations or political instability wiping out your investment. Think about it. You could buy a bond from a company in another country, and that company could be perfectly healthy. But if that country's currency suddenly loses half its value against the dollar, your investment gets cut in half through no fault of the company. You're adding layers of risk that are almost impossible for an individual investor to analyze properly. Today, things are a bit different. We have global funds and easier access to information. But Graham's core principle is as valid as ever. Don't invest in what you don't understand. If you can't confidently assess the political climate, currency risk, and local regulations of another country, you're not investing. You're gambling. For most enterprising investors, it's a game that isn't worth the risk. There are plenty of great opportunities right here at home that are much easier to research and understand. The third item on Graham's ban list is one that will probably surprise a lot of new investors. IPOs, or initial public offerings. These are a Wall Street favorite. The hype machine goes into overdrive, telling you to get in on the ground floor of the next big thing. They sell you a story of explosive growth and overnight riches. Graham calls this what it is, a sales tactic. Most IPOs are not offered to the public because the sellers want to do you a favor. They re-offered because the market is hot and they can get the highest possible price for their shares. You, the public investor, are often buying at the absolute peak of the hype. The data backs this up. Studies have shown that the vast majority of IPOs underperform the general market in the 1 to 5 years after they go public. For every one that becomes a massive success, there are dozens that fizzle out or crash completely. Sure, the insiders who got in early make a fortune, but the public who buys on day one, they're often left holding the bag. The enterprising investor isn't interested in hype. They're interested in value. They look for established companies with a long track record of profitability and a price that is reasonable or even cheap. IPOs, by definition, have no public track record and are almost always sold at a price that is anything but cheap. So your rule of thumb should be to let the hype die down. Wait a few years, let the company prove itself in the public market, and then, only then, analyze it like any other stock. So there you have it. Graham's 3 major no-go zones for the enterprising investor. No junk bonds, no unanalyzed foreign bonds, and no speculative IPOs. Wall Street loves nothing more than an IPO, an initial public offering. It's a huge party. You see the CEOs on TV, confetti is flying, bells are ringing, and everyone is celebrating. But Benjamin Graham? He hates them. He calls them new issues. So why the hate? It all comes down to one word: timing. Let me ask you a question. When would you sell your house? Would you sell it when the market is booming and buyers are practically throwing money at you? Or would you wait until the market crashes and nobody wants to buy? The answer is obvious, right? You sell when the market is hot to get the best price. Well, companies are no different. They choose to go public and offer an IPO precisely when the market is euphoric and investor excitement is at its peak. They are selling you shares at the exact moment they can get the highest possible price. This is why Graham gives us a clear rule. The intelligent investor does not buy new issues. Think about it. You're buying from a very smart seller, the company itself, who knows way more about their business than you do. At the very moment, the price is most likely inflated. For a modern example, just think back to the SPAC boom of 2021. Remember all those hot IPOs that everyone was piling into? And then remember what happened a year later. Many of them crashed, dropping 80% or more. That is exactly what Graham was warning us about over 70 years ago. The lesson here is simple. Wait. Let the company trade on the public market for a few years. Let all that initial hype and excitement die down. Then, and only then, should you start to analyze its real value. Next, Graham touches on foreign government bonds. Now, in today's globalized world, diversifying your investments internationally is generally a good idea. But Graham's warning is still incredibly relevant. And it's about currency risk. Imagine you buy a bond that pays you in a foreign currency. Everything seems fine, the bond is paying out as promised. But what if that country's currency suddenly collapses against your home currency, like the dollar? Poof, you've lost money even though the bond itself didn't default. For the enterprising investor, Graham's advice is to stick to what you can thoroughly analyze. Unless you happen to be an expert on the geopolitical and economic stability of a foreign nation, you're not really investing. You're just gambling on their currency. It's better to stick to your home court, where you understand the rules of the game and the economic landscape is much clearer. Finally, Graham gets to the heart of what being an enterprising investor really means. And it's probably not what you think. Most people hear enterprising or active and they picture a day trader. Someone glued to 6 different monitors, mainlining Red Bull, anxiously watching every little tick of the stock chart. Graham says absolutely not. To Graham, being enterprising means putting in the work. It means doing your homework. It means dedicating the time to actually read a company's 10K annual report. It means getting out your calculator and figuring out the tangible book value. It means checking the debt ratios and understanding the financial health of the business. If your idea of active investing is just scrolling through news headlines and buying whatever stock is trending on social media, Graham would say you're not being enterprising. You're being unintelligent. The whole point of this negative approach is to have the discipline to sit on your hands, sometimes for months at a time. It's about ignoring all the so-called opportunities that Wall Street is screaming about, and patiently waiting until you find that one true diamond in the rough. So let's turn this into an action plan. Let's do a toxic waste audit of your portfolio. This isn't about adding things. It's a game of subtraction. Get out a red marker. And let's go through your holdings looking for these specific red flags. First, recent IPOs. Do you own any stocks that went public in the last year or so? Be very, very careful with these. There's a high probability you paid a hype premium when you bought them. The excitement was high and the price was likely inflated. Second, junk bonds. Are you chasing high yields by investing in risky, low-quality bonds? That extra percentage point of yield might look tempting, but it often comes with a much higher risk of losing your entire principal. And third, a modern form of junk. Unprofitable tech stocks. Are you holding on to companies that lose money year after year? Just because the stock price has been volatile and exciting? If a company has no clear path to profitability, you are not investing. You are speculating. If you truly want to be an enterprising investor in the way Graham intended, you have to be willing to cut the fat from your portfolio. That means selling the speculation and keeping the cash ready for genuine, well-researched opportunities. It's about building a portfolio based on value, not hype. Alright, we've spent the last few chapters building our shield, learning what not to buy, and playing defense, but now it's time to pick up the sword. Welcome to Chapter 7 of The Intelligent Investor, a chapter dedicated to the enterprising investor. This isn't for the person who's happy with just matching the market. This is for the person who wants to outperform, who wants to beat the index. But here's the big secret, the catch, if you will. You don't beat the market by being smarter than everyone else. You beat the market by being more disciplined, by doing the hard work that other people are too scared or just too lazy to do. Today, we're flipping open Benjamin Graham's playbook to the positive side. We're going to learn how to hunt for bargains, how to find those rare opportunities to buy $1 for 50 cents. So grab your magnifying glass because we're going bargain hunting. Our first hunting ground is a place most people avoid, the large, unpopular company. Think about it. Typically, big, well-known companies are expensive. Everyone knows them, everyone loves them, and their stock prices reflect that popularity. But sometimes even a giant stumbles. Maybe they have a bad quarter and miss their earnings projections. Maybe they get hit with some negative press or a temporary scandal. Or maybe their entire industry just falls out of fashion for a while. What happens next? The market, being the emotional, manic-depressive beast that it is, panics. Investors rush for the exits, selling off the stock like it's radioactive, and the price gets pushed down until it's ridiculously cheap. Graham says this is your moment. This is the signal for the enterprising investor to move in. The logic here is powerful. A huge established company has deep pockets, vast resources, and a strong market position. They can weather a storm. A small, unproven company might go bankrupt after one bad year, but a giant can restructure, fire a CEO, launch new products, and almost always bounce back stronger. So the strategy is simple but not easy. You buy the blue chip stock when it's on the operating table, not when it's winning the marathon. You are buying quality at a deep, deep discount. This takes courage. It requires a strong stomach because you are clicking buy when every headline, every TV analyst, and every friend you have is screaming sell. You're betting on the company's long-term strength against the market's short-term fear. This is classic contrarian investing, and it's the first tool in our offensive arsenal. Now for our second strategy, perhaps Graham's most famous and most powerful technique of all. It's often called cigar butt investing, but Graham referred to them as bargain issues. This is where things get really interesting. He specifically looked for companies that were trading on the stock market for less than their net working capital. This sounds a bit technical, but the concept is incredibly simple and brilliant. Let's break down the math. Imagine a company has certain assets that are very liquid, meaning they could be turned into cash quickly. Let's say it has $100 million in its bank account. It also has $50 million worth of inventory products on its shelves ready to be sold. Let's keep it simple and say it has zero debt. So, its total liquid value or net working capital is $150 million. Now imagine you look at the stock market and the total price for the entire company, its market capitalization is only $100 million. Think about what that means. You could theoretically buy the entire company for $100 million, and the first thing you'd find inside is $150 million in liquid assets. You're literally buying cash at a 33% discount, and you get the rest of the business, the brand name, the factories, the machinery, the employees for absolutely free. It's like buying a wallet for $10 and finding $15 inside. This is what Graham called a net-net. It's the ultimate bargain. The catch? These companies almost always look terrible on the surface. They're usually losing money, their sales are declining, and they're in unglamorous industries. They are the ugly ducklings of the stock market. But the opportunity lies in the math. Graham knew that even if the company decided to shut down and liquidate everything tomorrow, the investors who bought at that cheap price would likely make a profit. The margin of safety isn't based on a prediction of future earnings. It's baked right into the balance sheet. You have a massive cushion against things going wrong, which is the cornerstone of intelligent investing. This is the art of finding those discarded cigar butts on the street that have one good puff left in them. It's not glamorous, but it can be incredibly profitable. So, let's recap the two main offensive strategies for the enterprising investor from this chapter. First, we have the large unpopular company. This is our contrarian play. We wait for a high-quality blue-chip giant to hit a temporary rough patch. While the market panics and sells, we step in and buy that quality business at a discount, confident in its ability to recover over the long term. This requires emotional fortitude. Second, we have the bargain issue, or the net-net. This is our deep value, quantitative play. We scour the market for ugly, unloved companies trading for less than the value of their current assets, minus all their liabilities. Our safety here comes not from a story about a great future, but from the cold, hard numbers on the balance sheet. This requires diligence and a willingness to look where no one else is looking. These two approaches form the foundation of an active, enterprising investment policy. They are not about outsmarting the market with complex algorithms or inside information. They are about discipline, patience, and doing your homework. It's about being a business analyst, not a market speculator. Whether you're buying a temporarily troubled giant or a statistically cheap microcap, the principle is the same. Find a significant gap between the price you pay and the value you get. That is the essence of beating the market, and it's the path of the true intelligent investor. Alright, so we've covered the defensive investor, who plays it safe, and the enterprising investor, who hunts for bargains. But Benjamin Graham, the master himself, had one more level, a sort of pro tier for the truly dedicated. These are special situations, the kind of investing that requires you to put on a detective hat and dig through some pretty complex stuff. It's not for everyone, but the potential rewards are why the pros love it. First up is what's called arbitrage. This isn't about fancy algorithms. It's simpler in concept. Imagine Company A announces they're buying Company B for $10 a share. But right now, Company B's stock is only trading at $9.50. An enterprising investor might buy shares of Company B, knowing that when the deal closes, they'll be worth $10. That 50-cent difference is their profit. Now, why isn't it already $10? Because deals can fall through, there's risk involved. The government might block it, or financing could collapse. The arbitrager's job is to figure out the real probability of the deal succeeding. If they're right more often than they're wrong, they make consistent, market-beating returns. It's less about forecasting a company's future, and more about analyzing the legal and financial details of a specific transaction. Next, we have spin-offs. This happens when a huge corporation decides to separate one of its divisions into a brand new, independent company. Think of a giant like General Electric spinning off its healthcare or energy business. Why is this an opportunity? Often, the parent company is so massive that the smaller division was just a rounding error on its financial statements. It was neglected, misunderstood, and unloved by Wall Street analysts who were focused on the bigger picture. When it becomes its own company, it's suddenly free. A new, motivated management team takes over, focused solely on making this one business succeed. For a little while, nobody pays attention to it. Big institutional investors who own the parent company might even sell their new shares immediately. Because the spin-off is too small for their massive portfolios. This creates a temporary price dip, and that's where the opportunity lies. An investor who does their homework can pick up shares in a good, newly independent business before the rest of the market realizes its potential. The third and perhaps most intense category is bankruptcy workouts. This is where you're not just reading financial reports. You're reading legal documents and court proceedings. When a company goes into bankruptcy, it doesn't always mean it's dead. Often it's just reorganizing. The goal is to restructure its debt so it can survive. The enterprising investor in this space isn't usually buying the stock, which often gets wiped out. Instead, they might buy the company's bonds or debt at a massive discount. For example, a bond that was once worth $1,000 might trade for just $100. The investor's job is to analyze the bankruptcy case and figure out what those bonds will be worth after the company emerges from reorganization. Will they get new stock? Will they get paid back a portion of their original investment? It's incredibly complex work. You're competing with hedge funds and specialized lawyers. But here's the key. Because it is so difficult and time-consuming, most lazy investors won't even touch it. And in finance, difficulty often creates opportunity. The lack of competition is precisely why the returns can be so incredibly high for those who get it right. Graham himself said this was a highly specialized field, but it perfectly illustrates the core idea. Find value where others aren't willing to look. Now, after all this talk about buying unloved, beaten down, and even bankrupt companies, you might notice something glaringly absent from Graham's list. He never tells you to find the next Amazon or invest in the hottest new technology. Where are all the high-flying growth stocks? This is one of the most important and counterintuitive lessons from Graham. Be very, very wary of growth. He gives a powerful warning that optimism is expensive. Why? Because by the time a company is widely recognized as a growth story, everyone knows it. The excitement, the hype, the news articles, it all gets baked into the stock price. When you pay 100 times earnings for a stock, you're not really being an enterprising investor. You're not buying a bargain, you're being an optimist. You're betting that the company will grow at an extraordinary rate for a very long time, just to justify the high price you're paying today. The problem is, the future is uncertain. A competitor could emerge. The technology could become obsolete. The CEO could make a terrible decision. Any hiccup can cause that optimistic bubble to pop, and the stock price can come crashing down. Graham's philosophy is rooted in buying a margin of safety. You buy assets for less than they are worth. When you buy a popular growth stock, you are often paying more than the current assets are worth, based on a promise of future earnings. In the world of finance, unbridled optimism is one of the most expensive commodities you can buy. The true enterprising investor buys value that exists today, not just promises about tomorrow. They are a realist, a financial detective, not a fortune teller. So if you're feeling that fire in your belly, if the idea of digging for treasure in the stock market's bargain bin excites you, let's turn this theory into action. Being an enterprising investor isn't a passive hobby. It's a job. It requires you to roll up your sleeves and do the work. So, if you're ready to punch the clock, I've got a mission for you. Let's call it the discount detective audit. First, you're going to need a tool. Open up a stock screener. There are great free ones online like FinViz or Yahoo Finance. These tools let you filter through thousands of stocks to find the ones that meet specific criteria. This is your magnifying glass. Second, we're going to filter for value. The most classic Graham metric is the price-to-book ratio, or PB, set a filter for companies with a PB ratio under 1.0. What does this mean? The book value is, in simple terms, the accounting value of a company's assets minus its liabilities. A PB under 1 means you are theoretically paying less for the stock than its assets are worth on the books. It's like buying a $10 bill for $9. It's a fundamental sign of a potential bargain. Third, let's filter for size and safety. Set the market capitalization to large cap, which usually means companies worth over $10 billion. Why? Because large companies have more resources, established brands, and access to credit. They have the financial muscle to survive a tough year or even a recession. We're looking for strong companies that are temporarily struggling, not small companies that are on the brink of collapse. Now for the most important part, the investigation. The screener will give you a list of companies. These will likely be the hated stocks of the moment. The news about them is probably terrible. Their industry might be out of favor. This is your list of suspects. Your job as the discount detective is to look at each one and ask the critical question. Is this company actually dying, or is it just having a really bad year? Is there a temporary problem, like a product recall, a bad management decision that can be fixed, or a cyclical downturn in their industry? Or is there a permanent problem like their entire business model is becoming obsolete? If you conclude it's just a bad year, you've found a potential enterprising investment. The strategy is simple. You buy it while it's unloved and cheap. You wait patiently for the problems to be solved and for the business to recover. And then, eventually, you sell it back to the trend followers and optimists once it becomes popular and expensive again. You buy fear and you sell greed. Now, a word of caution. If looking through financial statements and analyzing business problems sounds completely exhausting to you, that is perfectly okay. There's absolutely no shame in staying a defensive investor and focusing on index funds. It's a proven path to success. But if you want to take a more active role, if you enjoy the thrill of the hunt and have the discipline to go against the crowd, then becoming an enterprising investor could be an incredibly rewarding journey. It's about mastering the market's mood swings, not being a victim of them. Most people think the stock market is a math problem. They believe if they just find the right formula, they'll win. But Benjamin Graham, the father of value investing, knew better. In Chapter 8 of his masterpiece, The Intelligent Investor, a chapter Warren Buffett calls the most important ever written on investing, Graham reveals a profound truth. The market isn't a calculator. It's a person. And more specifically, it's a person with a severe personality disorder. Graham asks you to imagine you own a small stake in a private business. You have a partner, and his name is Mr. Market. Every single day, without fail, Mr. Market shows up at your front door. And he tells you what he thinks your share of the business is worth. The thing is, Mr. Market is manic depressive. Some days he's euphoric. He sees nothing but sunshine and blue skies, so he offers you a ridiculously high price for your share. He's practically jumping for joy, convinced the business is going to the moon. Then there are other days. On these days, he's utterly despondent. He's convinced the world is ending, that the economy is collapsing, and that your business is on the brink of failure. On those days, he offers you a price that is insultingly low, practically weeping as he tells you how worthless your share has become. Now here's the secret, the key that unlocks the entire philosophy. You don't have to listen to him. You have zero obligation to trade with him at all. Mr. Market is your servant, not your master. He is there to provide you with prices, not to tell you what your business is actually worth. You, the intelligent investor, have done your homework. You know the real, underlying value of your business based on its assets and earning power. His daily mood swings are irrelevant to that fact. So, when he shows up acting crazy, offering you a price that makes no sense, you just smile politely and close the door. Don't worry, he'll be back tomorrow with a completely different number. Your job is to ignore his madness and only engage with him when his offer serves your interests. You sell to him only when he is ecstatic and offering you far more than your share is worth. And you buy from him only when he is panicking and offering to sell you his shares for pennies on the dollar. This powerful parable leads us to the most famous quote in all of finance. Graham writes, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." What does that mean? In the short term, days, weeks, even months, stock prices are just a popularity contest. They are driven by votes, which are cast based on emotion. Fear, greed, hype, speculation, what's trending on social media. It's like a high school popularity contest where the most talked about kid wins, regardless of their actual character or substance. A company can be fundamentally solid, but if a wave of fear hits the market, people will vote to sell, and the price will drop. But in the long run, over years and decades, the market acts as a weighing machine. It stops caring about popularity and starts caring about substance. It weighs the actual tangible results of the company, its earnings, its profits, its assets, its cash flow. A truly valuable company will eventually see its worth reflected in its stock price, just as a heavy object will register its true weight on a scale. The noise of the voting machine fades and the reality of the weighing machine takes over. This distinction is crucial. If you are an investor, you care about the weight. You are focused on the long-term value and profitability of the business you are buying a piece of. If you are a speculator, you are just trying to guess who the popular kids will be tomorrow. You're trying to predict the votes, not measure the weight. The intelligent investor understands this difference. They see a sudden drop in a stock price not as a loss, but as an opportunity. It's Mr. Market in one of his depressive fits, offering a discount on the true weight of a great company. They don't panic. They see a sale. This mindset is what separates successful investors from the crowd. The crowd reacts to Mr. Market's every whim. They buy when he's euphoric and prices are high, and they sell when he's despondent and prices are low. They are his puppets. The intelligent investor does the exact opposite. They use their own analysis and judgment to determine value. They remain calm during the chaos because they know that chaos is just Mr. Market having a bad day. They profit from the market's personality disorder rather than becoming a victim of it. So the next time you see the market flashing red and feel that knot of fear in your stomach, remember Mr. Market. Is he offering you a price based on a rational assessment of value, or is he just in a panic? Is the crowd voting based on fear, or is the company's long-term weight actually changing? By learning to distinguish between the voting machine and the weighing machine, you can turn market fluctuations from a source of anxiety into a source of opportunity. Have you ever heard the saying, price is what you pay, value is what you get? It's one of the most powerful ideas in investing, and it comes directly from Benjamin Graham. Let's break this down because it's the key to unlocking true wealth and sleeping soundly at night. No matter what the market is doing, price is that number you see flashing on your phone screen. It's what Mr. Market, as Graham calls him, is screaming at you every second of the day. One minute he's euphoric, the next he's terrified. Value, on the other hand, is the real, tangible cash that the business you own actually generates over time. It's the profits, the assets, the fundamental strength of the company. Think about it this way. Imagine you just bought your dream house for $500,000. You know, it's a great house in a great neighborhood. Now, what if a crazy neighbor started knocking on your door every hour relentlessly? First, he offers you $400,000. An hour later, he's back, offering $600,000. Then $300,000. Would you panic? Would you let his frantic offers dictate how you feel about your home? Of course not. You'd probably ignore him or maybe even call the police. You know the true value of your house isn't determined by his manic mood swings. Yet, in the stock market, this is exactly what we do. We let that crazy neighbor, Mr. Market, live in our pockets and mess with our emotions every single time we check our phones. We see red and we panic, we see green and we get greedy. We've completely confused the frantic yelling of price with the quiet confidence of value. Now let's bring this into the 21st century, because the problem has gotten so much worse. Back in 1949, when Graham was writing, an investor had to wait for the morning newspaper to see Mr. Market's mood. It was a once-a-day event. Today, Mr. Market is right here in your pocket 24/7. He's not just a neighbor anymore. He's a tiny, screaming salesman who never sleeps. He's sending you push notifications. He is using bright red and green flashing lights specifically designed to trigger the dopamine receptors in your brain. That little rush you get when a stock goes up? That jolt of fear when it goes down? That's not investing. That's a biological reaction being exploited for profit. The modern financial system, from slick trading apps to financial news networks, is engineered to turn you from a calm, rational investor into a twitchy, emotional speculator. Why? Because they make money when you trade. Every time you buy or sell out of fear or greed, they get a commission, a spread, a fee. They profit from your activity, not your success. They want you to be that person frantically reacting to the crazy neighbor. Graham's timeless advice, if he were here today, would be simple. Mute the notifications. Turn off the noise. The more you stare at the price, the less you will understand the value. The more you react, the poorer you will become. So this all sounds great in theory, but how do we actually put it into practice? How do we build that mental fortress against Mr. Market's daily attacks? I call it the market fluctuations audit. It's a simple, 3-step action plan to see if you're truly an investor or just a speculator in disguise. First, check your horizon. Go look at your portfolio right now. Pick a stock you own. Now, imagine a headline tomorrow morning says that stock has dropped by 33%. What's your gut reaction? Is it a knot in your stomach? An urge to log in and hit the sell button to cut your losses? If the answer is yes, you probably shouldn't own that stock. Your emotional foundation is built on its price, not its value. You are speculating that the price will go up, not investing in the business itself. A true investor in that situation might even be tempted to buy more because the business they believe in just went on sale. Second, let's try the no-quote test. Graham famously said you'd be a better investor if your stocks had no market quotation at all. Let's run with that. Ask yourself this question for every company you own. If the stock market were to close for the next 10 years, and I couldn't sell this stock, would I still be happy owning this piece of the business? This question forces you to think like a true business owner. You're not buying a ticker symbol. You're buying a share of future earnings. If the thought of being locked in for a decade terrifies you, it's a huge red flag that you're focused on the price, not the company. Finally, and this is the most challenging step, you need to reverse your emotions. Our brains are hardwired to do the opposite of what's profitable in investing. We feel good when prices are high and bad when they're low. We need to retrain our brains. When the market is bleeding red and everyone is panicking, you need to see a clearance sale sign. This is your opportunity. These are the moments when great businesses are offered at silly prices by a fearful Mr. Market. Conversely, when the market is hitting all-time highs, when your portfolio looks amazing and everyone on social media is a genius, that's not the time to feel euphoric. That's the time to feel cautious. That's when the crazy neighbor is screaming an absurdly high price at you. Don't let the euphoria trick you into thinking you're a genius. It's just Mr. Market in one of his manic phases. A wise investor in this scenario might be thinking about trimming positions, not adding more. By performing this audit, checking your horizon, taking the no-quote test, and reversing your emotions, you can start to build the discipline Graham talked about. You can transform from a reactive speculator into a proactive investor. You can finally tell that crazy neighbor to get lost and focus on what truly matters. The long-term value of the businesses you own. Every single day, someone is trying to sell you a dream. Your broker calls with a sure thing. A finfluencer on TikTok tells you they've found the next 100x gem. Your bank is pushing a premium mutual fund with a 2% fee. Benjamin Graham knew that the biggest threat to your wealth isn't the market. It's the person sitting across the desk from you. Welcome to Chapter 9 of The Intelligent Investor. The Investor and His Advisors. This is the chapter where Graham teaches you how to spot a predator, how to hire a partner, and why most experts are actually paid to keep you average. Today, we're going to find out if you should be the captain of your own ship or if you're about to pay a pirate to sink it. Let's get one thing straight. In the financial world, free is the most expensive word in the dictionary. Graham warns us that most people get their advice from brokers. But here is the fundamental conflict. The broker's goal is to generate commissions, or order flow. They get paid when you move money. The investor's goal is to build wealth. You get rich when you hold money. Graham says that asking a broker for investment advice is like asking a car salesman if you need a new car. The answer is always yes. In 1949, they charged commissions. Today, they use payment for order flow and gamified apps to trigger your FOMO. They aren't your advisor. They are a salesperson. The intelligent investor knows that a hot tip from a broker is usually just a way to generate a fee for the firm. Now let's talk about the big guns, the investment banks and their army of analysts. These are the people who put out those fancy buy, sell, and hold ratings on stocks. You might think, these are the pros. They must know what they're doing. Graham would tell you to be extremely skeptical. Why? Because their business model is not about giving you unbiased advice. Investment banks have many departments. The research department analyzes stocks, but the investment banking department helps companies go public or raise money. Who pays the bills? It's the companies, not you. So, if an analyst's bank is trying to win a multi-million-dollar deal with a company, do you really think that analyst is going to slap a sell rating on their stock? It's a massive conflict of interest. Graham observed this decades ago, and it's even more true today. The research you see is often just marketing material in disguise. The goal is to maintain good relationships with corporations, not to make you rich. So, when you see a strong buy recommendation, the intelligent investor's first question should always be, who benefits from this buy? This brings us to the modern version of the stockbroker, the so-called finfluencer on platforms like TikTok and Instagram. They flash fancy cars and tell you about a secret crypto that's about to explode. They promise you financial freedom if you just follow their trades. Graham would have seen right through this. These influencers are often engaged in what's known as a pump and dump scheme. They buy a low-priced, obscure stock or coin, then they create hype around it, telling their thousands of followers to buy in. As the price skyrockets from all the new buyers, the influencer sells their own shares at the top, making a huge profit. And who's left holding the bag when the price crashes back to earth? You are. They aren't advisors. They're performers. They're selling you a ticket to a show where you're the one who pays the price. The intelligent investor doesn't chase hype. They analyze value. So if brokers, analysts, and influencers are all compromised, who can you trust? Graham suggests a different kind of advisor. A fee-only fiduciary. Let's break that down. Fee-only means they are paid a flat fee for their service, not commissions for selling you products. This removes the incentive to churn your account. Fiduciary is a legal term that means they are required by law to act in your best interest. This is the absolute gold standard. A true fiduciary success is tied directly to your success. But Graham adds a crucial point. Even with the best advisor, you can't outsource your own intelligence. You are the CEO of your own financial life. An advisor is a consultant, not your boss. You must have a basic understanding of your own investment policy, your goals, and your risk tolerance. You need to be able to ask your advisor tough questions. For example, why are you recommending this fund? What are the fees? How does this fit into my long-term plan? If they can't give you clear, simple answers, or if they try to dazzle you with jargon, that's a huge red flag. An honest advisor educates you. A dishonest one confuses you. The ultimate responsibility for your financial future always rests on your shoulders. Now, what about those expensive, actively managed mutual funds that your bank is always trying to sell you? The ones with the glossy brochures and the impressive sounding names. Graham was one of the first to point out a simple, devastating truth. The vast majority of these funds fail to beat the market average over the long run, especially after you account for their high fees. Think about it. A fund might charge a 2% management fee. That might not sound like much, but over 30 years that fee can eat up more than half of your potential returns. The fund managers get paid their handsome salary whether the fund goes up or down. You're the one taking all the risk, while they're guaranteed a paycheck. Graham's solution was simple and elegant. Instead of trying to find the one genius manager who can beat the market, why not just buy the market itself? This is the core idea behind index funds, which simply own a piece of every company in a major index like the S&P 500. They have incredibly low fees because there's no high-paid manager making guesses. You are guaranteed to get the market's return. For Graham, this wasn't about being average. It was about being smart. It's about recognizing that the high-fee game is rigged against you and choosing not to play. The intelligent investor doesn't pay for someone else's gambling addiction. So let's bring it all together. What is the key takeaway from Chapter 9? It's that your greatest defense in the investment world is not a fancy algorithm or a hot tip, but a healthy dose of skepticism. You must operate on the principle of trust, but verify. Graham teaches us to always question the motives of the person giving us advice. Are they a salesperson, a partner, or a performer? Are they being paid to make you money or to make money from you? The final and perhaps most important piece of advice from Graham is about knowing yourself. He divides investors into two types: the defensive investor and the enterprising investor. The defensive investor wants safety and freedom from bother. For them, a simple portfolio of low-cost index funds and bonds is the perfect solution. The enterprising or active investor is willing to put in the time and effort to research individual stocks in the hopes of beating the market. But this path requires serious work, discipline, and emotional control. The biggest mistake you can make is thinking you an enterprising investor when you really a defensive one. If you don't have the time or inclination to do deep research, but you still trade based on tips and feelings, you're not investing, you're speculating. And speculators almost always lose. Be honest with yourself about how much work you're truly willing to do. Choosing the right path for your personality is the most important investment decision you'll ever make. In the end, The Investor and His Advisors is a chapter about empowerment. It's Graham's way of telling you that you don't need to be a Wall Street genius to succeed. You just need to understand the rules of the game and know who's playing on your team. You need to build a fortress of knowledge around your money with a deep moat of skepticism to keep the predators at bay. The market will always be volatile, but your principles don't have to be. So what about the so-called experts? You know, the people you see on TV, the ones in those sharp, expensive suits on business channels, confidently telling you where the market is headed. Benjamin Graham points out something that's honestly a little terrifying. An advisor can be 100% honest, genuinely believing what they're saying, and still be 100% wrong. Think about that. They're not trying to deceive you. They just don't know. Graham actually analyzed the big investment counsel firms of his era. These were the top dogs, the most respected names in the business. And what did he find? They rarely, if ever, actually beat the market average. It's a shocking realization. So why does this happen? The core issue is something called groupthink. It's a psychological trap. In the world of high finance, advisors are incredibly afraid of being wrong and alone. If they make a bold, contrarian bet and it fails, their career could be over. So, what do they do instead? They huddle together. They all make similar predictions, buy similar stocks, and follow the same trends. This way, if they're wrong, which they often are, at least they're wrong and together. There's safety in numbers. They can all point to each other and say, well, everyone thought that was a good idea. This herd mentality protects their jobs, but it does absolutely nothing for your portfolio. This brings us to a fundamental rule from Chapter 3 of Graham's book, The Intelligent Investor. If an advisor sits across from you and claims they can predict with certainty where the S&P 500 will be in 6 months, or which tech stock is going to be the next big thing, they are violating the very essence of intelligent investing. At that moment, they've stopped being an advisor and have become a fortune teller. They're trying to sell you a crystal ball. And as we've learned from Graham, The first thing an intelligent investor does is smash that crystal ball to pieces. The future is unknowable, and anyone who claims otherwise is either a fool or a liar. So, does this mean Graham thinks you should just go it alone, navigating the treacherous waters of the stock market all by yourself? Well, not necessarily. He was a pragmatist. He understood that different people have different temperaments, different amounts of time, and different levels of interest in managing their own money. He basically divides the investing world into two distinct groups. First, you have the do-it-yourself investor. If you've embraced the defensive investor mindset we've talked about before, the one that focuses on simplicity, safety, and avoiding costly errors, you probably fall into this category. You're the kind of person who uses simple strategies like a 50-50 split between stocks and bonds, or invests primarily in low-cost index funds that just mirror the market. If this is you, congratulations. You likely don't need to pay anyone a dime for investment advice. You have the discipline and the strategy to be your own best advocate. You're in control and you're keeping your costs rock bottom, which is a huge advantage over time. But then there's the second group, the help seeker. Graham acknowledged that not everyone has the emotional fortitude to handle the wild swings of the market. And this is the only time he says you should really consider hiring an advisor. But here's the critical distinction. You're not hiring them to be a stock-picking genius. A truly great advisor in the Graham tradition isn't a stock picker. They're not trying to find hidden gems or time the market. A great advisor is a financial bodyguard. Their most important job is to protect you from your own worst impulses. They are the person who stands firmly between you and that glowing red sell button when the market suddenly crashes. 30% and every instinct in your body is screaming, "Get out now." You see, you aren't paying them for their alpha, that's the industry term for outperforming the market. You're paying them for their omega. You're paying them for their ability to stop you from doing something catastrophically stupid, like selling all your investments at the very bottom of a downturn and locking in massive losses. Their real value is behavioral coaching. They keep you on the right path, reminding you of your long-term goals and preventing panic from derailing your financial future. They provide the emotional discipline that you might lack. That's a service worth paying for, but paying someone to guess the future? According to Graham, that's just a waste of money. So if you're thinking about hiring a financial advisor, how do you find a good one in today's world? We can actually turn to Graham's wisdom, but let's update it for 2025. I call this the Graham test, and it has 3 non-negotiable rules. If a potential advisor fails even one of these, you walk away. First, rule number 1, the fiduciary standard. This is a big one. You need to ask them directly, do you have a legal obligation to put my interests first? This is what being a fiduciary means. If they hesitate or if they tell you they're a registered representative, that's a red flag. A registered rep only has to provide suitable advice, not the best advice for you. Think about that. Suitable just means it fits a general category. Best means it's the top choice for your specific situation. You deserve the best, not just something that's good enough. Insist on a fiduciary always. Second, rule number 2, fee only versus commission. How do they get paid? This is crucial. You should never ever pay an advisor a commission for a trade. When they make money every time you buy or sell something, what do you think they're going to encourage you to do? Trade more, of course. Their incentive is activity, not your long-term success. Instead, look for a fee-only advisor. They'll charge you for their time, like an hourly rate, or a flat, transparent percentage of the assets they manage for you. This aligns your goals perfectly. When your portfolio grows, their fee grows. When you win, they win. It's a partnership, not a transaction. And finally, rule number 3, the sleep test alignment. This ties back to everything we've talked about regarding being an intelligent investor. Does this advisor respect the foundational principles of sound long-term investing? Do they talk about value, margin of safety, and managing risk? Or are they pitching you the latest hot trend? If they suggest you put your retirement savings into 0-day to expiration options, or some speculative moonshot crypto coin, they are not an advisor. They are a gambler playing with your money. You need to fire them on the spot. A true advisor helps you build wealth patiently and protect it fiercely. They help you sleep well at night, not keep you up wondering if your life savings will be gone by morning. These 3 rules, fiduciary standard, fee only, and the sleep test, are your shield. They protect you from the wolves of Wall Street and ensure that anyone you bring into your financial life is truly on your team. Don't compromise on them. Now it's time for an action plan. I call this the gatekeeper audit. This is your mission, and it's one of the most important exercises you can do for your financial health. Your job is to become the strict, no-nonsense gatekeeper of your own wealth. First, I want you to identify the source. Take a look at the last 3 investment decisions you made. Could be buying a stock, a fund, anything. Now be honest with yourself. Who or what prompted you to make that decision? Was it based on your own careful, math-based analysis of the business? Or was it a hot tip from a friend, a suggestion from a broker, or something you saw on a flashy social media post? If the person who gave you the idea made money from your transaction, you need to be very critical of that influence. The goal is to separate sound analysis from sales pitches disguised as advice. Second, the fee reveal. This is for those of you who already have a professional advisor. I want you to do some digging. Find out exactly how much you paid them in total dollars over the last 12 months. Don't just look at the percentage. Percentages can be deceiving. For example, a 1% fee on a $500,000 portfolio doesn't sound like much, right? But do the math. That's $5,000 a year. That's over $400 a month. Now ask yourself the hard question. Is the advice I am receiving worth $400 every single month? Maybe it is, and that's fantastic. But maybe you'll find you're paying a premium for basic cookie-cutter advice you could get elsewhere for far less. You can't know until you see the actual dollar amount. Knowledge is power. And third, the influence mute. This one might be the most fun. I want you to open up your social media apps, YouTube, TikTok, Instagram, X, all of them. Scroll through the accounts you follow for financial advice. I want you to unfollow every single guru who promises guaranteed returns, secret strategies, or shows off a lavish lifestyle funded by their foolproof system. These people are not investors. They are speculators. And often their real product is selling you a dream, not providing real education. They prey on your desire for a shortcut. But as we know, in investing, there are no shortcuts. Mute the noise. Curate your feed so it's filled with sources that promote discipline, patience, and realistic expectations. Completing this gatekeeper audit is a massive step. It's about taking control and consciously deciding who gets to have a voice in your financial life. Remember, being an intelligent investor means you are the CEO of your own wealth. You are the boss. You can hire staff, like a good fee-only fiduciary advisor, to help you manage things. But you never, ever give up the power of the final decision. The buck stops with you. You are in charge of your financial destiny, and that's an incredibly powerful position to be in. Thanks for watching. Take this audit seriously. It can truly change your financial future. Most people look at a stock ticker and see a heartbeat up, down, jagged, erratic. They think the game is about guessing which way the line moves next. But Benjamin Graham? He didn't care about the line, he cared about the plumbing. He looked at a company the way a building inspector looks at a skyscraper. He didn't care if the paint was a pretty color. He wanted to know if the foundation was cracked. We're tackling Chapter 11, Security Analysis for the Lay Investor. This is where we stop being chart watchers and start being business owners. In the next few minutes, I'm giving you Graham's blueprint to find the true value of any company, broken down so simply that you can apply it tonight. First things first, what even is security analysis? Graham defines it as the study of facts to determine a company's safety and value. But he gives a powerful warning to the lay investor, and that's you and me. He says, don't try to be a Wall Street genius. You don't need a PhD in math. You don't need to calculate the fourth-degree derivative of a company's cash flow. Forget all that complexity. Your job, he says, is to be a detective. You are looking for one thing: the gap. The gap between the price Mr. Market is shouting at you today and the actual, tangible, underlying business value. To find that gap, Graham gives us a set of filters, a checklist. It's not about complex formulas. It's about disciplined investigation. Think of it this way. When you buy a house, you don't just look at the asking price and say, sounds good. You get an inspection. You check the foundation, the roof, the plumbing. You want to know what you are actually buying. A stock is no different. It's not a lottery ticket, it's a tiny piece of a real business. So before you buy that piece, you need to do your inspection. So if you're going to buy a stock, it must first pass what I like to call the Graham Gauntlet. These are the 5 pillars you need to check before you even think about clicking that buy button. This isn't about guesswork. This is about building a case. The first pillar is profitability. Is the company actually making money? I am not talking about adjusted EBITDA or pro forma non-GAAP earnings or any other financial jargon designed to confuse you. I'm talking about cold, hard net income. The bottom line. Graham wants to see positive earnings over a long period, at least 7 to 10 years. A single good year can be a fluke. A decade of profitability shows a resilient business model. Go to a site like Macro Trends or Yahoo Finance, pull up the income statement, and look at the net income line for the last 10 years. Is it consistently black, or is it a sea of red ink? If it's not profitable, you can stop right there. The second pillar is stability. Does the business crumble the moment the economy gets a cold? Graham specifically looks for companies that maintained their earnings even during recessions. Go back and look at 2008, or the brief downturn in 2020. How did the company fare? Did its profits fall off a cliff? Or did they hold steady? If their earnings chart looks like a wild roller coaster, Graham's advice is simple. Stay off the ride. You're looking for a business that can weather a storm, not one that capsizes at the first sign of a strong wind. This stability is a key component of your margin of safety. Now for pillar number 3, financial condition. This one is huge. Check the debt. A company can look profitable on the surface, but if it's drowning in debt, it's a ticking time bomb. Graham's famous rule of thumb here is the current ratio. He wants to see current assets be at least twice the current liabilities. Current assets are things the company can turn into cash within a year, like cash itself, inventory, and accounts receivable. Current liabilities are debts due within a year. If a company has $2 in short-term assets for every $1 of short-term debt, it means they have a strong cushion. They can pay their bills without breaking a sweat. If a company is drowning in debt, they aren't growing. They're just borrowing their way to a funeral. Pillar number 4 is the dividend record. For the defensive investor, Graham considered this non-negotiable. He looked for a long-term, uninterrupted record of dividend payments. Think 20 years or more. Why was he so obsessed with dividends? Because you can fake earnings with accounting tricks. A clever accountant can make a struggling company look profitable for a little while. But you cannot fake a check sent to a shareholder's mailbox. A dividend is real cash leaving the company's bank account and landing in yours. A long history of paying and even growing those dividends shows a stable, shareholder-friendly company that generates real cash. It's the ultimate proof that the business is healthy. Finally, we have pillar number 5, growth rate. Now, when you hear growth, you might think of tech stocks soaring thousands of %. That's not what Graham means. He isn't looking for rocket ships. He's looking for sensible, steady progress. His rule was to see a steady increase in earnings, usually at least a 33% total increase over the last 10 years, using 3-year averages at the beginning and end to smooth out any weird single-year results. That's not a huge hurdle. It's less than 3% per year. It just shows the company is moving forward, not backward or standing still. It's the difference between a mature, growing oak tree and a dying weed. So let's recap the 5 pillars of the Graham Gauntlet. 1. Consistent profitability for at least a decade. 2. Stability of those earnings even in tough times. 3. Strong financial condition with assets at least double the liabilities. 4. A long and uninterrupted dividend record. And 5. Modest but steady long-term growth in earnings. Notice what's not on this list. What's the hot new trend? What did my buddy tell me to buy? Does this stock have a cool story? None of that matters. This is a disciplined, fact-based approach. It's designed to remove emotion and speculation from the equation. Now, you might be thinking, that sounds like a lot of work. And it sounds like I'll only find boring companies. You're right on both counts. It is work. Investing, done properly, is not a passive activity. It requires a little bit of effort, a bit of detective work. But the tools to do this are freely available to everyone online. You can check these 5 points for any company in less than 30 minutes. And yes, the companies that pass these tests are often boring. You'll find companies that make soap or soda or sell groceries. They aren't the ones you hear about on the news every night. But as Graham would say, the goal of investing isn't excitement, it's to make money safely and reliably over the long term. Excitement is for the casino. Prudent investing is for building real wealth. By applying this 5-point checklist, you're not trying to predict the future. You're simply assessing the present reality of the business. You're finding strong, stable, profitable companies. And once you've found one, you then apply the final, most important principle of all, which we've talked about before, the margin of safety. You wait until Mr. Market, in one of his manic depressive moods, offers you that wonderful business for a price that is significantly less than its intrinsic value. This is the core of security analysis for the lay investor. It's not about being the smartest person in the room. It's about being the most disciplined. It's about having a process and sticking to it no matter what the market is screaming. So next time you look at a stock, don't just see the ticker. See the business, do your inspection, run it through the Graham gauntlet. Become the detective, not the gambler. Surprisingly, Chapter 11 starts with bonds. Why? Because Graham believed the true test of a stock begins with the test of a bond. Think about it. If a company's bonds aren't even safe enough to buy, then their stock is basically a lottery ticket. It's a pure gamble. This is where he introduces a powerful tool called the interest coverage ratio. It sounds complicated, but it's incredibly simple. All it asks is, how many times over can the company pay its interest expenses with its earnings? Let's say a company owes $1 in interest for every share. If they only earn $1.10, that's a huge red flag. Graham would call that the danger zone. One bad quarter, one unexpected event, and they could default. Graham didn't want a small cushion. He wanted a massive one. A fortress. He wanted to see a company that could earn its interest 4, 5, or even 6 times over. That powerful buffer, that extra protection, that's your margin of safety. It's the difference between sleeping soundly at night and nervously checking your phone every 5 minutes. Before you even think about buying a stock, you need to know if the company can comfortably pay its most basic bills. That's the foundation of intelligent investing. Now, here is where Graham gets a little controversial, especially in today's market. He gives a stern warning to the everyday investor: be extremely careful with growth stocks. Now, he isn't saying they won't go up. Of course they can. What he's saying is that they are practically impossible to value accurately. When you buy a popular growth stock, like the AI darlings or tech giants everyone's talking about today, you're not just paying for what the company is doing right now, you're paying for future hope. You're betting on what they might become in 5 or 10 years. But Graham reminds us of a crucial, unchanging law of the market. The more people expect from a company, the higher the price goes. And the higher the price, the smaller your margin of safety becomes. The stock becomes priced for perfection. One tiny miss on an earnings report, one slight delay in a product launch, one new competitor, and the stock can absolutely collapse. For the intelligent investor, a great company can be a bad investment if the price is simply too high. It's not about the story. It's about the price you pay for that story. So if we're not supposed to bet on hope, what do we use? Graham's secret weapon was a concept he called earning power. He wasn't interested in just looking at last year's earnings. Anyone can have one good year. A single great quarter could be a fluke, a bit of luck, or a one-time event. Instead, he took an average of the last 7 to 10 years of earnings. Why? Because one good year could be luck, but 7 to 10 good years? That's not luck. That is a business model. That's a durable, predictable machine. He would then take that stable, averaged earning power and compare it to the price of the stock. Let's make it simple. If a company on average earns $10 per share and the stock costs $100, you're getting what's called a 10% earnings yield. Now, compare that to what you can get elsewhere. If your bank is only paying you 4% interest on a savings account, that stock starts to look like a fantastic bargain. You're getting more than double the return for your money. This is the core of value investing, comparing a business to a savings account and choosing the one that pays you more with a margin of safety. All right, now it's time to put this into action. This is your mission for Chapter 11. I want you to stop trading and start analyzing. I want you to become a business analyst, not a stock picker. You can do this today, right after this video. First, the 10-year look back. Go to a free website like Yahoo Finance or Morningstar. Find your single biggest stock holding in your portfolio. Now look up their net income for the last 10 years. Is the line a steady upward climb? Or is it a jagged, unpredictable mess, up one year and down the next? If it's a mess, you need to be honest with yourself. You're not an investor in a stable business. You're a hopeful spectator at a chaotic game. Second, the debt check. On that same page, look for a metric called total debt to equity. If that number is over 1.0, it means the company owes more than it actually owns. They are leveraged to the hilt. Ask yourself a simple question. Am I truly comfortable owning a piece of a business that is buried in this much debt? What happens when interest rates rise? What happens in a recession? That debt becomes an anchor. And third, the dividend loyalty test. Has your company ever cut its dividend in the last decade? A dividend isn't just a payment, it's a promise. It's the company sharing its profits with you, its partner. If they cut that dividend the moment times got a little tough, they showed you their true colors. They don't value you as a long-term partner. And if that's the case, Benjamin Graham would tell you to go find a more loyal partner for your hard-earned capital. Do this security audit on your top holding, and you'll know more about your investment than 90% of the people who own it. That's how you become an intelligent investor. It's the number that can make a stock soar to the moon or crash and burn in a single day. I'm talking about earnings per share or EPS. Everyone loves a slice of the pie in the stock market. EPS is that slice. When a company releases its earnings report, this is the headline number everyone looks at. But Benjamin Graham has a crucial warning for us. That pie you're being offered, it might be made of cardboard and the person slicing it, they could be a master of misdirection. So let's dive into Chapter 12, Things to Consider About Per-Share Earnings. Today, I'm going to show you how companies can use accounting magic to make a loss look like a profit. And more importantly, how you, the intelligent investor, can see right through the smoke and mirrors. First, let's talk about the pro forma mirage. Graham noticed a dangerous trend that has exploded in the modern era, especially with tech companies. It's the practice of reporting adjusted or pro forma earnings. The company will essentially say, hey, we would have made $1 billion. If you just ignore the $500 million we spent on that factory that failed and the $200 million in legal fees, and oh yeah, the $300 million we gave our CEO in stock options. They create a fantasy version of their performance. Graham's rule here is simple and powerful. If a company tells you to ignore one-time expenses every single year, well, then they aren't one-time expenses, are they? That's just the cost of doing business. When you see the words adjusted EPS, your internal alarm bells should be ringing loud and clear. As an investor, you don't want the fairy tale version of the earnings. You want the cold, hard reality, which is usually found in the GAAP numbers, that stands for Generally Accepted Accounting Principles. That's where the real story is. Next up is the extraordinary trap. Companies are absolute experts at using special items to dress up their financial statements. Imagine a company that manufactures widgets. This year, they lost $10 million actually making and selling those widgets. It was a bad year for their core operation. But in the same year, they happened to sell their old headquarters for a profit of exactly $10 million. So on the final earnings report, what's the bottom line? A big fat zero. The EPS looks flat, stable, no big deal, right? Wrong. Graham would tell us to look closer. That $10 million profit from selling the building is a one-time gain. It's an extraordinary event. A company can't sell its headquarters every year to cover up losses. The $10 million loss from manufacturing, however, that's a recurring problem. That's the real health of the business. If you just look at that final EPS number without digging deeper, you're missing the critical fact that the actual business is failing, and a lucky real estate deal is hiding the truth. The intelligent investor always separates the ordinary earnings, the ones that come from the main business, from the extraordinary fluff. Let's move on to another clever trick, the dilution deception. This one is all about stock-based compensation. It's incredibly common, especially in Silicon Valley. A company needs to attract top engineers and executives, but maybe they don't have a lot of cash. So what do? They pay them with stock options. It seems like a great deal. The company conserves cash and the employees are motivated to help the stock price go up. But here's the catch that Graham saw coming a mile away. When those options are exercised, the company has to issue millions of new shares. This means the total number of shares outstanding increases. And what happens when the number of shares goes up, but the total profit stays the same? Your slice of the pie, the earnings per share, gets smaller. It's called dilution. A company might report a fantastic headline profit of, say, $100 million. But if they also issued so many new shares that your ownership stake was effectively cut in half, are you really better off? The intelligent investor doesn't just look at the total net income. They look at the fully diluted earnings per share. This number accounts for all the potential new shares from options and convertible bonds. It gives you a much more honest picture of your real claim on the company's profits. Don't let a company distract you with big profit numbers while it is quietly shrinking your piece of the pie. Another area where accounting gets creative is with something called depreciation. Now, this might sound a bit boring, but stick with me because it's where a lot of the magic happens. Depreciation is an accounting concept where a company spreads the cost of a big asset, like a factory or a fleet of trucks, over its useful life. So, if a $1 million machine is expected to last 10 years, the company might record a depreciation expense of $100,000 each year. The problem is, the useful life of an asset is just an estimate. A company can make its profits look much better in the short term by being overly optimistic. They could say, oh, this new machine, it'll last 20 years. By doing that, they cut the annual depreciation expense in half from $100,000 to just $50,000. And just like that, $50,000 magically appears on the bottom line as extra profit. It's not real cash, it's just an accounting choice. Graham's advice is to be skeptical. Look at a company's depreciation policies and compare them to their direct competitors. If one company is depreciating its assets much more slowly than everyone else in the industry, that's a red flag. It might be a sign that management is trying to artificially inflate their current earnings at the expense of future periods. True earnings power comes from selling products and services, not from creative accounting schedules. So, how do we put this all together and protect ourselves? Graham gives us a practical tool. Look at the average earnings over a long period. Instead of getting fixated on last quarter's or even last year's EPS, the intelligent investor calculates the average EPS over the past 7 to 10 years. Why is this so powerful? Because it smooths out all the noise. A 10-year average will include good years and bad years. It will capture the impact of those one-time charges that seem to happen every other year. It will wash out the effects of a single big asset sale. It will show you the true underlying earning power of the business, stripped of all the accounting gimmicks and short-term fluctuations. When you look at a stock, don't just ask, what were the earnings last year? Ask, what were the average earnings over the last decade? This long-term perspective is your best defense against being fooled by creative accounting. It forces you to think like a business owner, not a speculator chasing the latest news release. It's about understanding the durable profitability of the enterprise you're considering buying into. In summary, earnings per share is not a simple number. It's a story, and companies are very good at telling the story they want you to hear. But now you have the tools to read between the lines. First, be wary of adjusted or pro forma earnings. Always seek out the GAAP reality. Second, separate the one-time extraordinary items from the real ordinary business profits. Third, always look at fully diluted EPS to see the true impact of stock options. And finally, use a long-term average of earnings at least 7 to 10 years to get the real picture of a company's earning power. By applying these principles from Benjamin Graham, you stop being a passive consumer of financial news and become an active, intelligent analyst. You learn to spot the red flags and see through the accounting fog. This is what separates the intelligent investor from the crowd. Have you ever seen your stock go up after a great earnings report, only to find yourself poorer in the long run? There's an invisible thief at work, and its name is dilution. This is probably the sneakiest way investors lose money. Benjamin Graham, the father of value investing, specifically warned us about two culprits: convertible securities and stock options. Let me show you what I mean. Imagine this beautiful cake represents a company's profits. At the start of the year, it's cut into 4 big slices and you own one of them. Nice. But then, the company issues a ton of stock options to its employees. When those employees exercise their options, they're essentially buying new shares at a discount. Suddenly, the company takes your big slice and cuts it into a dozen tiny slivers to give to everyone else. The cake didn't get any bigger, but your piece of it just became a crumb. This happens all the time. A company might proudly announce they earned $1 per share. Sounds great, right? But what they do and scream from the rooftops is the millions of unexercised stock options lurking in the background. If all those options get turned into shares, the total number of shares skyrockets. Your ownership stake, your claim on the company's future profits, gets diluted. It's like pouring water into a glass of fine wine. It looks like you have more, but the quality is gone. This is why Graham insisted that we, as intelligent investors, must always look at a company's diluted EPS, or diluted earnings per share. This number tells you what the earnings per share would be in a worst-case scenario if every single option, warrant, and convertible security were exercised today. It's the honest number. If you see a huge gap between the basic EPS, the company headlines, and the diluted EPS buried in the report, that's a massive red flag. It means the company is effectively printing new money for insiders and devaluing your investment in the process. They're paying their bills with your future wealth. So, with all these accounting tricks and dilution demons lurking around, how do we possibly protect ourselves? How do we find the truth? Graham gives us a brilliantly simple, if a little boring solution, the 7 to 10 year average. He argued that looking at a single year of earnings is like watching one frame of a movie and trying to guess the entire plot. It's impossible. You might be looking at the one scene where the hero wins right before disaster strikes. To get a real sense of a company's true earning power, Graham would meticulously calculate the average earnings over the past 7 to 10 years. This simple act of averaging smooths out the noise. It accounts for the years when the company got a lucky break, like a one-time asset sale. And it also factors in the years when they faced a disaster, like a recession or a product failure. It reveals the underlying durable profitability of the business, not just a snapshot in time. If you find that a company's 10-year average earnings are consistently growing, you've likely found a solid, well-managed business. But if the 10-year average is flat or declining, yet this year's earnings are a record high, be very, very suspicious. You're probably looking at a temporary spike, an earnings bubble, and paying a premium for it is a recipe for losing money. This long-term perspective is your shield against market hype and accounting shenanigans. Now let's bring Graham's wisdom into the 21st century, because his warnings are more relevant today than ever, especially in the tech world. Hold up your smartphone. The companies that make these and the software on them have perfected a modern form of Graham's dreaded accounting trick, stock-based compensation. Many of today's tech giants don't pay their brilliant engineers entirely in cash. Instead, a huge chunk of their salary comes in the form of company stock. From the company's perspective, this is genius. They get to call it a non-cash expense. It doesn't drain their bank account. So when they present their adjusted earnings or non-GAAP profits, they often tell you to just ignore it. They subtract it from the expense column, magically boosting their profitability. They'll say, "Look how much money we're making. If you don't count how we pay our people." But for you, the shareholder, this cost is very, very real. It is a direct drain on your wealth. Every share they give to an employee is a share that dilutes your ownership. If a company claims it as profitable only after ignoring the cost of its single most important asset, its people, then it isn't actually profitable. It's playing a shell game. They are simply moving the cost off their income statement and putting it directly into your pocket in the form of a devalued investment. It's the ultimate accounting sleight of hand. Okay, let's put this all together into an action plan. I call it the earnings reality check. The next time your favorite stock drops its quarterly earnings report, I want you to ignore the screaming headlines and the fancy CEO interviews. Instead, lean in and do these 3 things. First, find the GAAP gap. Go into the financial statements and find 2 numbers. Net income calculated according to GAAP, that is the generally accepted accounting principles, the official rules, and then find their adjusted net income, the number they really want you to see. If the difference between these 2 numbers is more than, say, 10 or 15%, you need to ask a critical question. What are they trying to hide in that gap? Second, perform the one-timer audit. Dive into the footnotes. Yes, the boring part at the back of the report. Look for things called restructuring charges, impairment costs, or asset write-downs. Companies love to call these one-time or special items to justify excluding them from their adjusted profits. But if you see these one-time items showing up year after year, they're not one-time events. They are regular recurring costs of doing business, and the company is lying to you about its true profitability. And third, calculate the 10-year average. Go to a financial data site, pull up the company's earnings per share for the last 10 years. From 2014 to 2024, add them all up and divide by 10. This gives you the smoothed out true earning power. Now, compare that average APs to the current stock price. Is the stock price more than 20 times that 10-year average? If it is, you are paying a massive premium not for reality, but for hope. You're betting on a perfect future, and as Graham taught us, that is speculation, not investment. By using this simple 3-step reality check, you can cut through the corporate spin and see the business for what it truly is. You'll protect yourself from the accounting games that trap so many investors. Benjamin Graham takes 2 real-world companies and puts them through a forensic audit. He wants to show you how a company that looks like a safe giant can actually be a house of cards, while a smaller, boring company can be a goldmine. Today, we're doing the same. We're going to look at Graham's original Battle of the Titans and then apply those exact 1949 rules to 2 modern giants to see who is actually winning in 2025. This is where you learn to tell the difference between a legacy in decline and a compounding machine. To compare 2 companies, Graham doesn't just look at the stock price. That's what speculators do. The intelligent investor looks at the DNA of the business. Here are the 5 metrics Graham uses to declare a winner. First, profitability. Is the company actually making more money than it did 10 years ago? It sounds simple, but you'd be surprised how many popular stocks fail this basic test. We're looking for a clear, upward trend in earnings per share. Second, stability. Did they lose money during the last recession, or did they sail through? A truly great business has the resilience to thrive even when the economy is in turmoil. We want to see consistent profits year after year without any major dips into the red. Third, the dividend record. Have they paid shareholders consistently for 20 years or more? Graham saw this as proof of a company's commitment to its owners and a sign of long-term financial health. An uninterrupted dividend history is a powerful signal. Fourth, financial strength. This is a big one. Do they have enough cash and liquid assets to pay all their short-term debts twice over? This is called the current ratio. A ratio of 2 or higher means the company has a massive safety buffer. And finally, number 5, price versus value. Are you paying a hope premium for future growth that might never happen, or are you buying the company for less than its tangible assets are worth? Graham wanted to buy $1 for 50 cents, and this metric tells us if we're getting a bargain. So let's go back in time. In Graham's day, the Titan was Penn Central. It was a massive railroad. Everyone owned it. It was prestigious. It was considered too big to fail. The compounder was a company called Emerson Electric. It was smaller, focused on industrial manufacturing, and didn't have the glamour or the prestige of the railroad. It was, for lack of a better word, boring. On the surface, Penn Central looked like the obvious choice for a conservative investor. It was a cornerstone of the American economy. But Graham wasn't interested in the story. He was interested in the numbers. When he applied his 5-point audit, he saw a disaster waiting to happen. Penn Central was drowning in debt. Its financial strength was abysmal. Worse, they were borrowing money just to pay their dividends. Think about that. They were taking on new loans to pay their shareholders. That is the absolute definition of a safety trap. It's a house of cards, creating the illusion of stability while the foundation is crumbling. Emerson Electric, meanwhile, had a pristine balance sheet. It passed the financial strength test with flying colors. It was growing earnings every single year without taking on massive debt, and its dividend was backed by real profits, not borrowed cash. The result? In 1970, Penn Central went through one of the biggest and most shocking bankruptcies in American history. Thousands of investors who bought into the reputation were wiped out. Emerson Electric? It went on to become a dividend king, raising its dividend for over 60 consecutive years. It became a textbook example of a compounding machine. Graham's lesson is timeless and more relevant today than ever. Never, ever buy a stock because of its reputation or because it's popular. Buy it because the math works. So let's bring this lesson into the modern era. We're going to stage our own battle of the titans. For our titan, a company with an incredible legacy, a household name, we've chosen a giant in the consumer goods space. For our compounder, we've selected a less glamorous but highly efficient player in the industrial sector, one that many people might not even know. First, let's look at our titan. The brand is iconic. For decades, it was the definition of a blue-chip stock, but when we run the Graham audit, we see some red flags. Let's look at profitability. Over the last decade, earnings growth has been almost flat. It's a massive company, but it's not growing. It's treading water. Next, stability. It did survive the last recession, so it gets a check mark there. It's a stable business. But what about the dividend record? Yes, it has a long history of paying dividends, but lately the payout ratio has been creeping up. This means a larger and larger percentage of its profits are going to dividends, leaving less for reinvestment or a safety cushion. It's not quite at Penn Central levels of danger, but it's a warning sign. Now for financial strength. Their current ratio is sitting around 1.1. Remember, Graham wanted to see a 2. This means they only have enough liquid assets to cover their short-term debts one time, not twice. The margin of safety is thin, and finally, price versus value. The stock is not outrageously expensive, but it's certainly not trading for less than its tangible book value. You're paying a fair price, perhaps a slight premium for a business that isn't really growing. The math just isn't compelling. Now let's turn to our compounder. This is a company that makes essential components for the tech and industrial sectors. It's not a flashy name. They don't run Super Bowl ads, they just execute. Let's run the Graham audit. Profitability? Over the last 10 years, earnings per share have more than tripled. That is explosive, consistent growth. Stability? They sailed through the last recession with record profits. They actually got stronger when others got weaker. Dividend record? They've been raising their dividend for 25 straight years, qualifying them as a dividend aristocrat. And the payout ratio is a healthy 40%, leaving plenty of cash to reinvest in growth. Financial strength? Their current ratio is 2.8. That's an A+ by Graham's standards. They could pay off all their immediate bills almost 3 times over with cash on hand. The balance sheet is a fortress, and price versus value. This is the best part. Despite its incredible performance, the market has overlooked it. It's currently trading at a price to tangible book value of just 1.2. You are buying this high-growth, financially sound business for barely more than its physical assets are worth. So, who wins the battle of 2025? The legacy titan is stable, but it's stagnant and financially stretched. It's living on its past glory. The compounder is a quiet, disciplined, and relentlessly growing machine with a fortress balance sheet. For the intelligent investor, the choice is clear. You ignore the headlines and follow the numbers. The compounder is the clear winner. This exercise is the entire philosophy of this series in a nutshell. Investing isn't about picking the most popular or exciting companies. It's about being a business analyst. It's about doing your homework, staying disciplined, and always demanding a margin of safety. The tools Graham gave us in 1949 are just as powerful today. If not more so, in a market filled with hype and speculation. This concludes our deep dive into the intelligent investor. Let's fast forward to today, say 2025. If Graham were alive, he'd see the exact same patterns playing out. But in the semiconductor industry, imagine this showdown. The legacy giant, Intel, versus the growth king, NVIDIA. Intel, in many ways, looks like Penn Central did back in the day. It's the old guard with massive, expensive factories. But let's run it through the Graham audit. First, earnings growth. Intel's earnings have been all over the place, mostly declining. What about debt? They're pouring billions into building new fabs to catch up, which is stretching their finances thin. And here's the trap. So many investors look at Intel and think, wow, it's cheap compared to its history. But Graham would wave a huge red flag here. A stock isn't a bargain if the underlying business is deteriorating. It's what he called a value trap. Now let's flip the coin and look at NVIDIA. Their earnings, absolutely explosive. They've been on a tear riding the I wave. And safety of principle? They're in a great position with more cash on hand than debt. It's a fortress balance sheet, so it seems like a clear winner, right? Well, here's the Graham twist. Nvidia is currently trading at a massive price-to-earnings ratio. It's incredibly expensive. Graham would look at this situation and say something like this: Nvidia is clearly the better business, but Intel is the cheaper stock. However, neither one might be a good investment right now. Why? Intel fails the quality test because the business fundamentals are shaky. But Nvidia fails the value test because its price is so high. You're essentially paying a massive premium for the hope of future growth. You're not buying a business. You're buying a story. Graham was never a fan of paying for stories. So what's the big lesson here? It's that you need to do this analysis for your own portfolio. I want you to try this today. Don't just think, I own some tech stocks, or I'm invested in retail. You need to compare them head to head. I call this the side-by-side audit. It's simple. Step 1. Pick 2 companies in the same industry. It could be Coke versus Pepsi, Ford versus Tesla, or Home Depot versus Lowe's. Step 2. Go to their investor relations website and pull up their latest annual report, the 1OK filing. All the data you need is in there. Step 3. Fill out that 5-point checklist we just covered. Look at their earnings trends, debt levels, and the price you're being asked to pay. Step 4. Ask yourself the crucial question: which one is the compounder and which one is the trap? If you do this and find that one of your favorite stocks has declining earnings and rising debt, you need to be honest with yourself. You aren't an investor in that company. You're a passenger on a sinking ship. And Graham's advice is crystal clear: get off the ship while there are still lifeboats. Do and go down with it just because you've held it for a long time or because it used to be a great company. The market doesn't care about the past. It only cares about the future. This simple exercise can be the difference between building real, lasting wealth and just hoping for the best. It's about being an active, intelligent owner of businesses, not a passive speculator. So take some time this week, pick a couple of stocks from your portfolio, and do the side-by-side audit. You might be surprised by what you find. Most people treat the stock market like a lottery. They hear a tip on Reddit, they see a headline on TV, and they press buy. Benjamin Graham calls those people speculators. And as we've seen, speculators eventually go broke. But chapter 14 is different. This is the chapter where Graham gives you the Holy Grail. He provides a mathematical filter, 7 specific rules that turn stock picking from a guessing game into a cold, hard science. If a stock doesn't pass all 7, you don't touch it, period. Today, we are building the Graham scanner. We're going to filter through thousands of companies to find the rare defensive gems that actually deserve your hard-earned money. Before we dive into the rules, Graham drops a truth bomb that the Wall Street elite hate. Most professional fund managers cannot beat the S&P 500. It's a fact, year after year. Studies show that the majority of highly paid experts fail to outperform the market average. In this chapter, Graham was one of the first to suggest that for most people, a simple, low-cost index fund is the ultimate defensive play. Buying an S&P 500 index fund means you own a tiny piece of the 500 largest companies in America. You get diversification, low costs, and a track record of historical growth, all without the stress of picking individual winners. For many, this is the smartest and safest way to invest for the long term. It's the set it and forget it strategy that lets you beat the pros by doing almost nothing. But for those of you who want to pick your own stocks, who want to build your own portfolio, Graham says you must be a skeptic. You aren't looking for reasons to buy. You are looking for reasons to reject. Your job is to be the bouncer at the most exclusive club in finance. Thousands of stocks will line up, trying to get in, and you're going to turn almost all of them away. This mindset shift is critical. You're not a cheerleader. You're a judge. So let's build this filter. Here are the 7 criteria a stock must meet to be defensive grade in the eyes of Benjamin Graham. This is the 7-step process to find true value. First, adequate size. Graham wanted big, stable companies. He knew that smaller companies, while they have potential for huge growth, also carry huge risks. They can be wiped out by a single bad quarter or a new competitor. In 1949, his benchmark was $100 million in annual sales. Today, adjusted for inflation and the growth of the economy, we're talking about companies with a market capitalization of at least $2 billion. This isn't an arbitrary number. A $2 billion company is established. It has resources, brand recognition, and the ability to weather economic storms. Small caps are simply too volatile for the defensive investor. We're looking for giants, not startups. Second, a strong financial condition. This is the debt test. Imagine a company as a fortress. Its walls are its assets, cash, buildings, inventory. The attackers are its liabilities, the debts it owes. Graham insisted that the fortress walls must be at least twice as high as the attacking force. In technical terms, the company's current assets must be at least double its current liabilities. This is called the current ratio. It means that for every dollar of debt due in the next year, the company has at least $2 of liquid assets to cover it. This isn't just about safety, it's about flexibility. A company that isn't drowning in debt has the freedom to invest, to innovate, and to survive when its competitors are struggling to make interest payments. They are what we call fortress companies. Third, earnings stability. We're not interested in one-hit wonders or companies that have a great year followed by a terrible one. The defensive investor needs consistency. Graham S. rule is strict. The company must have reported positive earnings every single year for the last 10 years. No losses allowed. Not one. Think about what this means. A company that has remained profitable through a decade has proven its business model works. It has survived recessions, market crashes, and shifting consumer tastes, and it still made money. This demonstrates a durable competitive advantage and a management team that knows how to navigate challenges. A single year of losses in the last 10 is an immediate disqualification. Fourth, a consistent dividend record. This is the loyalty test. A dividend is a portion of the company's profits paid out to shareholders. It's real cash in your pocket. For Graham, this was non-negotiable. He required a company to have paid a dividend without interruption for at least the last 20 years. Why 20 years? Because that time frame is almost guaranteed to include market panics, wars, and economic downturns. A company that keeps paying its shareholders through thick and thin is demonstrating a profound commitment to them. It shows that management prioritizes returning value to its owners. If a company cuts its dividend, it's a huge red flag. For the Graham filter, they're out of the club. Fifth, earnings growth. A company can't just stand still. It has to be a growing machine. Stability is great, but we also need progress. Graham required a minimum increase of at least 1/3 in per-share earnings over the past 10 years, using 3-year averages at the beginning and end of the period to smooth out any fluke years. That's a compound growth rate of about 2.9% per year. It might not sound like much, but it's a crucial hurdle. It separates the healthy, growing businesses from the ones that are slowly stagnating. We want companies that are not just surviving, but actively increasing their earning power over time. Sixth, a moderate price-to-earnings ratio, or PE ratio. This is where we make sure we don't overpay, even for a great company. The PE ratio tells you how much you're paying for $1 of the company's earnings. Graham's rule was clear. The stock's current price should be no more than 15 times its average earnings over the past 3 years. Why 15? Because it represents a reasonable earnings yield of about 6.7%. This rule forces you to avoid the hyped-up, high-flying story stocks that trade at crazy multiples. It keeps you grounded in reality and focused on buying earnings at a sensible price. Don't overpay for hype. And seventh, a moderate price-to-book ratio. This is the final layer of protection. The book value is, in simple terms, the company's net worth, what would be left over if it sold all its assets and paid off all its debts. Graham wanted to buy stuff, not just promises. His rule states that the price should be no more than 1.5 times its last reported book value. This ensures you're buying tangible assets at a fair price. However, Graham offered a little flexibility here. He said you could bend this rule slightly if the PE ratio was very low. He gave a final formula. The PE ratio multiplied by the price-to-book ratio should not be more than 22.5. This allows you to pay a little more for a company with great earnings, or a little more for one with tons of assets, but never too much for both. So there you have it. The 7 pillars of the Graham scanner. Adequate size, strong financials, a decade of positive earnings, 20 years of dividends, steady earnings growth, a PE under 15, and a price-to-book under 1.5. In today's market, Finding a company that passes all 7 of these tests is incredibly rare. It's like finding a needle in a haystack. But that's the point. The goal isn't to find hundreds of stocks to buy. It's to find the very few that meet an incredibly high standard of safety and value. This process transforms you from a gambler into a disciplined business analyst. It forces you to ignore the noise and focus on the numbers that truly matter. It provides a framework for making rational decisions in an irrational market, showing you how to use online screeners to find these defensive gems for yourself. But for now, understand these 7 rules. This is the blueprint for intelligent investing. The Graham number. If those 7 rules seem like too much work, Graham gave us a shortcut. It's called the Graham number. Formula: square root of 22.5 times earnings per share times book value per share. If the current stock price is higher than this number, you are overpaying. This formula combines the PE and the PB into one safety ceiling. If you buy below this number, you have a massive margin of safety built into the math. The reality check, modern examples. Let's run the scanner on 2 famous stocks right now. Company A, Apple, market cap, huge. Financials, strong. Earnings, growing. But look at the PE and PB. Apple currently trades at a price far higher than Graham's limit. Graham would call Apple a great business, but a speculative stock at these prices. Company B, a boring industrial like Mueller Industries or Cal-Maine Foods. These aren't flashy. They don't make headlines. But many of these boring companies pass all 7 tests. They have low debt, 20 years of dividends, and they are priced cheap. To the world, they are boring. To the intelligent investor, they are gold. Your action plan. Graham says, the investor's chief problem and even his worst enemy is likely to be himself. This 7-step filter is your shield. It stops you from following your emotions and forces you to follow the math. Your homework today: take 1 stock in your portfolio. Go to Yahoo Finance or Seeking Alpha, run it through the 7 pillars. Did it pass? Or are you holding a speculative trap? In the last chapter, we built a fortress. We learned the 7 rules for the defensive investor, the ultimate set-it-and-forget-it strategy. It's about safety, automation, and earning the market average. But I have a feeling that's not why you're really here. You don't just want the market average. You want to beat it. You're looking for alpha. Welcome to Chapter 15 of The Intelligent Investor. This isn't just a chapter. It's a level up. This is the Bargain Hunter's Manifesto. Benjamin Graham, the father of value investing, understood something fundamental about the market. It's bipolar. It gets overly excited about popular, glamorous stocks, but more importantly for us, it often undervalues great businesses just because they seem boring, are temporarily out of favor, or are simply too small for the big Wall Street firms to even notice. So today, we're putting on our headlamps. We're going into the dark, forgotten corners of the market to find what Graham called enterprising bargains. This is where the real work and the real rewards begin. But first, a crucial warning. Graham is crystal clear on this point. The enterprising investor does not get higher returns by taking on more risk. They get higher returns by doing more work. Think of it like a scale. On one side, you have return, and on the other, you have effort. To raise one, you have to raise the other. If you aren't prepared to spend your weekends reading annual reports, tracking industry cycles, and potentially waiting years for your investment thesis to play out, then honestly, it's better to stick with the defensive strategy from Chapter 14. There's no shame in that. It's a proven path to wealth. But if you have the discipline to be a financial detective, if you're ready to put in the effort, then here's how we find the market anomalies that others miss. To find these hidden gems, Graham allows the enterprising investor to loosen the screws a little bit on the strict rules we set for the defensive investor. We're not throwing caution to the wind, but we are expanding our search criteria to include what he calls secondary companies. These aren't the household names like Apple or Coca-Cola that everyone knows and analyzes to death. Let's compare the rules side by side. For the defensive investor, we demanded a current ratio of at least 2.0 super safe. The enterprising investor can be more flexible, looking for a ratio of 1.5. This means the company has 1.5 times more current assets than current liabilities. It's still healthy, just not a fortress. When it comes to earnings, the defensive strategy required 10 straight years of profitability. For our enterprising search, we can look at just the last 5 years of profit. This opens the door to companies that may have had a tough time in the past but have since turned things around. For dividends, the defensive investor needed an uninterrupted 20-year history of payments. The enterprising investor just needs to see some current dividend payment. It's a sign of financial health and shareholder-friendly management, but we don't need the decades-long track record. And finally, price. The defensive investor wouldn't pay more than 15 times average earnings. The enterprising investor can be a bit more selective, aiming for a price below 12 times earnings, because we're looking for deeper bargains. By slightly lowering these requirements, we open up a whole universe of smaller, more specialized companies that the big institutional machines are forced to ignore simply because of their size. A billion-dollar fund can't invest in a $50 million company. It wouldn't even move their needle. But for us, that's where the opportunity lies. So, where do we actually hunt for these bargains? Graham gives us 3 specific hunting grounds to find alpha. Imagine 3 doors. The first is labeled the contrarian, the second, the secondary bargain, and the third, the special situation. Let's open the first door. The unpopular large cap. This is the contrarian play. We're looking for a giant, well-established company that the market currently hates. A perfect recent example is Meta, the parent company of Facebook, back in late 2022. The world thought the metaverse was a colossal joke. The stock had crashed over 70%, and the headlines were screaming that its best days were over. But if you ignored the panic and looked at the numbers, the business was still a cash-printing machine. That was a classic Graham-style unpopular giant. The strategy is simple. You buy when the headline screams panic, but the math whispers profit. You're betting that the market's short-term mood swing has created a long-term opportunity. Now for the second door, the secondary bargain. These are solid but overlooked companies. They aren't startups, but they aren't the undisputed leaders in their field either. Think of the number 3 or number 4 player in an otherwise healthy industry. Graham loved looking for these companies when they were trading at a very low price-to-earnings ratio. Why? Because the market often gets obsessed with the industry leader and completely forgets about the competition. If the number 1 company in the sector is trading at 30 times its earnings, and the number 3 player with similar profit margins and a healthy balance sheet is trading at just 8 times its earnings, that's your entry point. You're buying a solid business at a deep discount simply because it's not the prom king. Finally, we come to the third door, special situations, or what Graham called workouts. This is for the true pros, the investors who are willing to do the most homework. We're talking about things like spin-offs, mergers, arbitrage, and liquidations. For example, when a huge corporation spins off a smaller division into a new, independent company, the big institutional shareholders of the parent company often get shares of this new small stock. Many of them will sell it immediately, not because the business is bad, but because it's too small for them to bother with. This flood of selling creates a massive, temporary price drop that has absolutely nothing to do with the underlying value of the new business. Graham called these workouts because you literally have to work to find and understand them. But the potential payoffs can be enormous and often independent of the broader market's direction. Now, for the ultimate bargain, the holy grail of Chapter 15. This is the concept that made Benjamin Graham a legend, the net-net. A net-net is a company that is trading on the stock market for less than its net current asset value. The logic is almost absurdly simple. Imagine a business has $10 million in current assets, like cash and inventory that can be easily sold. And let's say it has $2 million in total debt. Its net current asset value or liquidation value is $8 million. Now, what if the stock market is valuing the entire company, its total market cap, at only $5 million? Think about that. You could theoretically buy the entire company for $5 million, sell off its current assets to get $10 million, pay off the $2 million in debt, and be left with $3 million in pure profit. You're essentially being paid $3 million to take the business for free. Graham built his early fortune on these types of investments. They are much rarer to find today in a normal market, but during a market crash or a deep recession, they reappear. And when they do, they are the buy signals of a lifetime. But as with all great power, this knowledge comes with a great responsibility. Graham ends this chapter with a stern reality check. He warns that most people who think they are being enterprising investors are actually just day trading with extra steps. They're speculating. If you're buying a stock because it has momentum, or because you heard a cool AI story, or because a TV analyst got you excited. You are not following the principles of Chapter 15. You're gambling on price movements, not investing in business value. The true enterprising investor is a business buyer, first and foremost. Before you buy a single share, ask yourself this question. If the stock market closed for the next 5 years, would I still be happy owning this company based purely on its operations and its balance sheet? If the answer is no, sell it. Or better yet, don't buy it in the first place. Your analysis should make you confident in the business itself, not the stock's daily price wiggles. Chapter 15 is where the amateur can truly become a professional. It's the point where you stop looking at squiggly lines on a chart and start looking at businesses. It's about transforming your mindset from a stock renter to a business owner. But the journey doesn't end here. What happens when companies start using clever financial engineering to hide their true value or disguise their weaknesses? What about complex securities like convertible bonds and warrants that can dilute your ownership without you even realizing it? Imagine you buy a pizza with 8 slices. You own the whole thing. But just as you're about to take a bite, the chef walks out and cuts every single slice in half. You still have slices, but now you only own half the pizza you started with. In the stock market, this is called dilution, and it's the #1 way that management teams can steal value from unsuspecting shareholders. Benjamin Graham hated this. In Chapter 16 of his classic book, he exposes what he calls the convertible trap. Securities that look like safe investments but are actually ticking time bombs for your portfolio. Today, we're going to become financial detectives. We're going to learn how to spot this silent thief before it empties your brokerage account. Graham starts with 2 culprits, convertible bonds and warrants. On the surface, they sound amazing. A convertible bond is basically a loan you give to a company. They'd pay you interest, which feels safe, but if the stock price goes up, you can convert that bond into shares of stock and ride the profits. Wall Street sells these as the best of both worlds. But Graham calls them a logical fraud. Why? Well, think about it. If the company does really well, the bondholders will all convert their bonds into stock. This creates millions of brand new shares, which dilutes your ownership and keeps the stock price from rising as much as it should have. But what if the company does poorly? The bondholders don't convert, of course, but now the company is stuck with a mountain of debt it can't pay back. So for the common shareholder, it's often the worst of both worlds. Graham was writing about this back in 1949, but today the silent thief has a new, much more common name: stock-based compensation, or SBC. Many modern tech companies, especially in hot sectors like AI and software, don't pay their employees just in cash. They pay them in stock options. Every single time an employee exercises one of those options, a new share of stock is born. This can be incredibly misleading. If a company tells you they made $1 billion in profit, but at the same time, they issued $1.2 billion in new stock to their employees, did they really make money? No, they just shifted the cost from their own balance sheet directly into your pocket as a shareholder. Your slice of the pizza got smaller to pay their bills. This brings us to the most important part of Chapter 16 for any modern investor. It's what I call the headline lie. When you pull up a company's earnings report, you'll almost always see 2 different numbers for earnings per share, or EPS. The first is basic EPS. This is the company's profit divided by the number of shares that exist right now. It looks clean and simple. The second number is diluted EPS. This is the truth number. This is the profit divided by all the shares that could exist if every single person exercised their options, their warrants, and converted their bonds. Benjamin Graham's rule here is simple. Never ever look at basic EPS. It's a fantasy number. It's not real. You must always look at diluted EPS. If the diluted EPS is significantly lower than the basic EPS, you've found a dilution machine. It's a massive red flag that you are buying a constantly shrinking piece of the pie. We saw Graham's warnings play out perfectly a few years ago with the SPAC boom. SPACs, or special purpose acquisition companies, were often loaded with warrants. Promoters and celebrities went on TV telling retail investors that the stock was a great deal at $10. But what they didn't mention was the fine print. Hidden in the legal documents were millions upon millions of warrants that allowed insiders and early promoters to buy the stock for just pennies on the dollar. As soon as the stock price hit a certain target, these insiders flooded the market with all their cheap, newly created shares. The price collapsed. The regular retail investors, the ones who didn't read, Chapter 16 were left holding the bag while their ownership stake was slashed by 50% or even more overnight. It was a classic, textbook case of the convertible trap. So, how do you protect yourself from this silent thief? You need to perform what I call the Graham dilution audit before you buy any stock. It's a simple 3-step checklist. First, check the share count trend. Go to a financial website like Macro Trends or Yahoo Finance and look up the historical number of shares outstanding for the company. Is that number going up every single year? If it is, the company is effectively printing money for themselves and their employees, not for you, the owner. Second, use the 2% rule. If a company is diluting its shareholders by more than 2% a year through stock-based compensation or warrants, it better be growing its revenue by something huge like 20%, just to compensate you for that dilution. If the growth isn't there to justify it, walk away. And third, the most important step, read the fine print. Dig into the company's annual report and find the section called Notes to Financial Statements. Then look for a subsection titled Commitments and Contingencies. That's the dark alley where the silent thief hides the details about warrants, convertible debt, and employee stock options. This is where you find the truth. By running this audit, you can spot the dilution traps before they cost you a fortune. You'll be investing like Graham, focusing not just on the potential upside, but on protecting yourself from the hidden risks. Most people go to the stock market looking for the next big winner. But the professional, the intelligent investor, goes to the market looking for the big losers. Why? Because if you can study how companies die, you can learn exactly how to stay alive. In Chapter 17, Benjamin Graham takes us into the morgue. He examines 4 specific companies that were massive success stories in the late 60s, only to collapse in the early 70s. These aren't just old stories. These are the exact same mistakes being made today by companies in the S&P 500. Grab your scalpel. It's time for some financial autopsies. Case number 1, Penn Central. At the time, this was the largest railroad in the world. It was a blue chip. It was prestigious. People bought it for their grandkids' college funds because they thought it was safe. The stock was trading over $80 a share. It was a pillar of the American economy. But the autopsy reveals a hidden cancer: debt. Penn Central was borrowing money just to pay dividends to keep shareholders happy. They were literally burning the floorboards of the house to keep the heater running. Their income statements looked okay, but the balance sheet was bleeding out. Graham's lesson? If a company's debt-to-equity ratio is spiraling while they keep bragging about prestige, run for the hills. Within a few short years, the stock collapsed to just $2. A blue chip became a bankruptcy chip. Case number 2, Lingtemco Vought or LTV. This was the original conglomerate. They bought everything. They were a tech company that bought a steel company that bought a meatpacking plant. The CEO, James Ling, was hailed as a financial genius on the cover of magazines because his earnings were growing every single year. It seemed like he could do no wrong. The stock soared. But let's look closer at the cause of death. It was financial engineering. They were using complex financial instruments like convertible bonds and warrants, everything we learned about in Chapter 16, to buy these other companies. LTV wasn't actually growing its core business. It was just eating other companies to hide its own internal rot. The growth was an illusion created by accounting tricks. When the economy slowed down and the music stopped, the massive pile of debt crushed them. Think of the massive tech acquisitions today. If a company stops innovating and starts just buying growth, they are becoming an LTV. Case number 3, AAA Enterprises. This was the hype IPO of its day. They sold mobile homes. They went public at $13 a share, and within months, the stock was at $28. The story was perfect. Post-war America was booming. People wanted affordable housing, and mobile homes were the future. Everyone wanted a piece of the new economy. The media loved it, analysts loved it, and the public piled in. The problem? The company had almost no real assets. They were all hope and no home. Their balance sheet was paper thin. They were selling a dream, not a sustainable business. Within 2 years, the stock that everyone was so excited about was worth 25 cents. It had lost over 99% of its value. Graham uses this to warn us. Never, ever buy a stock just because the story sounds good. If the balance sheet is empty, the story is a fairy tale. Finally, case number 4, NVF Corporation. This was a tiny, obscure company that made vulcanized fiber. Nobody cared about it. But then they did something audacious. They used a massive amount of debt, specifically junk bonds, to buy a massive company, Sharon Steel. It was a minnow swallowing a whale. On paper, it looked like a miracle. This tiny company now controlled a giant in the steel industry. Its assets ballooned overnight. The stock went crazy. But the reality was grim. The interest payments on the debt were so incredibly high that even when the steel company was profitable, all that money went straight to the bondholders. The actual shareholders of NVF got nothing. The minnow had choked on the whale. Today, we see this exact same pattern in aggressive leveraged buyouts or LBOs. If the debt used for an acquisition is bigger than the company itself, you aren't an investor. You're a gambler betting that everything will go perfectly. Graham didn't write this chapter to depress you. He wrote it to give you a survivalist checklist. He wants to arm you against the financial predators and your own worst impulses. So before you buy any hot stock today, ask yourself these 3 autopsy questions. First, is the growth organic or engineered? Are they actually making better products and gaining more customers, or are they just buying other companies to make their revenue numbers look bigger? Look for innovation, not just acquisition. Second, is the dividend earned or borrowed? A dividend is great, but where's the cash coming from? Look at the free cash flow on the cash flow statement. If the total dividend paid out is consistently higher than the free cash flow, they are a modern-day Penn Central. They're borrowing from the future to pay you today. By studying these corporate corpses, you can learn to spot the diseases that kill companies before they infect your portfolio. We've done the theory, we've looked at the history, we've even performed the autopsies on failed companies. But now it's time to play the game. In Chapter 18, Benjamin Graham stops teaching and starts betting on paper, at least. He takes 8 pairs of companies. He puts them side by side, looks at their stats like they're athletes, and shows you exactly how the market gets the price wrong. This is the final exam of value investing. Today, we aren't just reading Chapter 80, and we are going to use Graham's 8-point scorecard to compare a modern tech darling against a value workhorse to see who the real winner is. This is where the rubber meets the road, where we separate real investments from pure speculation. It's time to see if Graham's timeless wisdom can still pick winners in today's fast-paced market. Graham's genius in this chapter is the comparison. He argues that you can know if a stock is cheap just by looking at its price. You have to compare it to its peers. He looks at pairs of companies in the same industry. He asks, why is company A selling for 40 times earnings, while company B, which has more cash and less debt, is selling for only 10 times earnings? Usually the answer is hype, and Graham loves to bet against hype. Think about it. A high price doesn't mean a company is better, it just means it's more popular. Graham's entire philosophy is built on finding value where others only see what's boring or overlooked. He's teaching us to be financial detectives, looking for the clues the rest of the market has missed. When Graham compares his 8 pairs, he uses a 3-round scoring system. Let's look at how he identifies a strong buy versus a dangerous sell. Round 1 is all about earnings quality. Is the company making money from selling products or from accounting tricks? Graham looks for per-share growth that is steady, not a jagged mountain range of gains and losses. He wants consistency. A company that can reliably grow its profits year after year is demonstrating a strong, sustainable business model. It's not about one-time windfalls or financial engineering. It's about real operational success that builds shareholder value over the long term. Round 2 is the asset pillar. If the company went out of business tomorrow, what's left? Graham compares book value. In one of his 1970s examples, he shows a company with a stock price of $40 but only $5 in tangible assets per share. He compares it to a rival with a stock price of $20 and $30 in assets. One is a balloon filled with nothing but hot air and hope. The other is a safe, backed by real, physical value. This is the foundation of the margin of safety. You're buying a piece of a real business with real assets, not just a ticker symbol with a good story. That asset base provides a floor for your investment, protecting you if the market turns sour. Round 3 is dividend discipline. Does the company respect you, the shareholder? Graham shows that companies with long-term dividend records almost always outperform the high flyers who reinvest all their cash into growth that never actually shows up. A consistent dividend is a sign of a mature, profitable company. It shows that management is disciplined and focused on returning value to its owners. It's a tangible reward for your investment and a powerful signal that the company's profits are real. It's proof that cash is actually flowing through the business and into your pocket. So let's run a Chapter 18 comparison for today's market. Let's look at the cloud wars. Snowflake, the high-growth darling, versus Oracle, the legacy giant. On the Snowflake side, you see massive revenue growth. Everyone loves the story. It's the future of data warehousing, and the market is pricing it for perfection. But when you look closer, the PE ratio is astronomical, often in the hundreds or even non-existent because they aren't consistently profitable. And they spend a huge chunk of revenue on stock-based compensation. That's the silent thief from Chapter 16 diluting your ownership. Now, let's look at the Oracle side. It's boring. It's older. It's not the exciting growth story that gets all the headlines. But look at the Graham stats. Positive cash flow, a solid dividend that has been growing for years, and a PE ratio that is grounded in reality. The company is a cash-generating machine. Graham would likely say, Snowflake might be a great company, but Oracle is the better investment operation. He's not saying Snowflake won't go up. He's saying Oracle has the margin of safety if the market crashes. He's asking which company offers you more business for your buck. The answer is clear. The biggest takeaway from Chapter 18 is this. The market is not a weighing scale in the short run. It's a voting machine. Graham shows us that at any given time, the voters, that's the public, the emotional crowd, are obsessed with one company in a pair and totally ignoring the other. Your job as an intelligent investor is to find the company that is being voted down, even though its weight, its actual earnings and assets is increasing. You're looking for the unpopular candidate with the strongest platform. He literally proves that the cheap stocks in his pairs outperformed the expensive ones by massive margins over the following 5 years. It's not a theory, it's a historical fact. This isn't just an idea he had. It's a strategy he tested and documented with real-world examples. He laid out the evidence chapter by chapter, showing that over and over again, price and value eventually converge. By buying quality businesses at a discount to their intrinsic value, you are putting the odds of success firmly in your favor. So before you buy your next stock, I want you to find its twin, create your own head-to-head battle. If you want to buy Tesla, compare it to BYD. If you want to buy DraftKings, compare it to Flutter. Run them through these 3 simple questions. First, which one has more cash per share? Second, which one has a lower debt-to-equity ratio? And third, which one gives me more earnings for every $1 I invest? If the flashy stock fails all 3 tests, you're not investing, you're just following the crowd. You're getting caught up in the story instead of focusing on the facts. This simple exercise forces you to be objective and to think like a business owner, not a speculator. It's your personal scorecard for making intelligent investment decisions. Chapter 18 is the proof that the numbers don't lie, even when the market does. We've seen the battles. We've seen the scorecards. But there is one thing we haven't discussed in depth yet. The reward. In our next session, we'll dive into what Graham calls the dividend factor and why getting paid to wait is one of the most powerful forces in investing. For 18 chapters, we've talked about how to buy a stock. But today, we talk about what happens after you click that buy button. Most people think they are just holding a ticker symbol. Benjamin Graham says that is a loser's mindset. The moment you buy a single share, you are an owner, the CEO. He's your employee, the board of directors. They work for you. In Chapter 19, Graham teaches us the owner's rights and specifically how to handle the most important question in finance. Where is my money? Today, we are moving from the ticker tape to the boardroom. Let's talk about dividends, management, and your right to get paid. Imagine you own 20% of the best pizza shop in town. At the end of the year, the shop has $100,000 in profit. The manager tells you, I'm going to keep all the money. I might buy a fancy new oven, or I might just leave it in the bank. You get nothing? Would you be okay with that? Of course not. You'd demand to see the plan. If that new oven doesn't make the shop more profitable, you want your cash. Yet, in the stock market, millions of investors let CEOs hoard billions of dollars in cash with no plan and no dividends. Graham says an intelligent investor must be a demanding owner. So how do you know if a company should be paying you? Graham has a very simple rule for dividends. He believes a company should pay out its profits to shareholders unless it can prove it can grow that money faster than you can. If a company keeps your money, which we call retained earnings, and uses it to grow their profits by 15% a year, great. Keep it. But if they keep your money and the company's growth stays flat at 2%, they are stealing your opportunity cost. They should have given you that cash so you could invest it elsewhere. In the past, Graham argued for a high payout ratio. Today, we can adapt that rule. We look at it this way. Is the company's return on equity higher than what I could get in a simple index fund? If the answer is no, I want my dividend. It's that simple. They either use your money better than you can or they give it back. Now, Graham warns us about a classic management trick, the stock dividend or its cousin, the stock split. Management sends you a letter saying, "Good news. We're giving you a 2-for-1 stock split. You now have twice as many shares." Graham's response? So what? You haven't gained any actual value. You just have more pieces of the same pizza. It's an accounting trick designed to make the stock look cheaper and more accessible. But don't confuse a stock split with a cash dividend. One is a gift of paper. The other is a gift of cold, hard cash. One is an illusion of wealth, the other is actual wealth in your pocket. Always focus on the cash. Graham wrote his book before the age of massive share buybacks. Today, companies like Apple and Google don't just pay dividends. They spend billions buying back their own stock. Graham would have had a complex relationship with this modern strategy. There's a good side and a bad side. The good side is, if the stock is undervalued, buying back shares is a brilliant move. It makes your remaining shares more valuable because you own a bigger piece of the company. But there's a very bad side. If the stock is overvalued, which it often is when CEOs are feeling confident, management is literally burning your money to artificially pump the stock price. Why would they do that? Often, it's so their own stock-based bonuses hit their targets. That is a betrayal of the shareholder. When you see a buyback, you must ask, is this a smart capital allocation or is management just trying to line their own pockets? So how do you fight back? How do you hold management accountable? Every year, you probably get an email about proxy voting. Most people delete it thinking it's junk mail. Don't. This is your power. This is your chance to vote on executive pay, board members, and major corporate decisions like mergers. Graham encouraged us to be active shareholders. If management is overpaying themselves while the stock price is flat, you vote no on their compensation package. If they are hoarding cash while the business is stagnant, you demand a dividend. You aren't a fan watching from the sidelines. You're the principal, the owner of the school. Your vote matters. Here is your homework for Chapter 19. This is your Roner's audit. I want you to take the largest holding in your portfolio and look up two simple numbers. First, the payout ratio. What percentage of their profit are they giving back to you in dividends? For a stable, mature company, anything between 30 and 60% is usually the sweet spot. If it's zero, you need to ask why. Second, the retained earnings growth. Look at the last 5 years. Has their earnings per share grown at a faster rate than the cash they kept? If they kept $10 billion but profits only grew by $1 million, you have a management problem. They are not using your capital effectively. If you treat management like your partners, you'll be treated like a partner. If you treat them like your masters, you'll be treated like a victim. Chapter 19 is about taking your seat at the table. It's about shifting your mindset from a passive stock trader to an active business owner. But now, we have reached the end of the journey. We have analyzed the market, filtered the stocks, performed the autopsies, and audited the management. We've traveled together through 19 chapters of The Intelligent Investor. We've journeyed through the history of the market. We've navigated the treacherous mood swings of Mr. Market. We've filtered through thousands of stocks, and we've audited countless management teams. But if you forget everything V taught you, if you delete every spreadsheet and lose every checklist, there are 3 words that can still save your financial life. Benjamin Graham called them the secret of sound investment. Today, we unlock the final door. Welcome to Chapter 20, the margin of safety. Imagine you're an engineer building a bridge. You know that, at most, 10,000-pound trucks will drive across it. Do you build the bridge to hold exactly 10,000 pounds? Of course not. You build it to hold 30,000 pounds. Why? Because you might be wrong about the weight of the trucks. There might be a hidden crack in the cement. There might be an earthquake. That extra 20,000 pounds of strength is your margin of safety. In the stock market, most people build bridges that can barely hold their own weight. They buy a stock at $100 because they think it is worth $105. If they're even 6% wrong, the bridge collapses and they lose money. The intelligent investor only buys when the bridge is built for 30,000 pounds. Graham defines the margin of safety as the difference between the intrinsic value of a business and the market price you pay for it. If a company is worth $50 per share based on its assets and earnings, and you buy it for $48, you have no margin of safety. If you're wrong by just $3, you're in the red. But what if you buy that same company for $30? Now you have a $20 cushion. You could be wrong about the growth, the CEO could quit, a competitor could launch a new product, and you could still make money. The margin of safety is your protection against your own ignorance. Wall Street wants you to believe that to get higher returns, you must take higher risks. They want you to buy volatile, unproven companies. Graham says that is absolute nonsense. The intelligent investor knows that the lower the price you pay, the lower the risk and the higher the potential return. By buying a stock at a massive discount to its value, you are actually decreasing your risk while increasing your upside. This is the value investor's edge. We don't take risks. We take calculated bargains. Even with a margin of safety, Graham gives us one more layer of armor: diversification. He admits that even a margin of safety stock can fail. Sometimes the bridge is built for 30,000 pounds, but a 40,000-pound truck shows up. But if you own 20 different margin of safety stocks across 20 different industries, the odds of all of them failing at once are almost zero. Margin of safety tells you how to pick the soldier. Diversification tells you how to build the army. We live in a world of 24-hour news cycles, AI-driven, high-frequency trading, and get-rich-quick influencers. It's easy to feel like the intelligent investor is a relic of the past. But the math of 1949 is the same as the math of today. The human brain is still governed by fear and greed. Mr. Market is still bipolar. And the only way to survive the long game is to never, ever overpay. Benjamin Graham's legacy isn't a formula. It isn't a specific stock pick. It is a philosophy of discipline. It is the courage to say no to a good company at a bad price, and the patience to wait for a margin of safety that makes success almost inevitable. Thank you for watching this series. If you found value in this journey, please like this video, subscribe to the channel, and share it with someone who needs to hear this message.